Hello, my name is Oktay Urcan. I am an Associate Professor of Accounting here at University of Illinois. I teach financial accounting related classes at the undergraduate, MBA, Executive MBA and PhD levels. I have been associated with the University of Illinois for about 2 years. Before that, I was an Assistant Professor of Accounting at London Business School in the United Kingdom. I conduct research in the archival capital markets area. My recent research interests are in the growing interdisciplinary research area called macroaccounting, which studies the interaction between macroeconomy and accounting. My research investigates how aggregated accounting numbers help predict important macroeconomic variables, including GDP growth, employment growth, and inflation. I will be teaching financial accounting course in our IMBA program. Accounting is the language of business. Decision makers both within and outside of firms in business life need relevant and reliable information to make decisions. In this class, you will develop a deep understanding of particular type of information provided by each financial statement and how decision makers can benefit from financial statements. Accounting knowledge also serves as a foundation for other classes you will take in IMBA program. These classes include finance and strategy. Welcome to financial accounting. Let's begin.
Too often, smart, hardworking, busy people miss out on education because of traditional linear learning. So learn on your terms. With stackable online content from Geese College of Business, you can take self-paced classes, earn transcriptable credit, pause, earn a degree, switch and stack coursework, earn a certificate, or learn however you want. You'll get expert-led education in big or bite-sized increments. Wherever you are in your learning journey, the right time to start at Geese is your time.
Hello, welcome to first class of Financial Accounting Foundations here at University of Illinois. Here is a very brief overview of what we are going to do today. First, we are going to define what accounting is, and then we will go through what financial accounting is, and finally, we will discuss in detail three main financial statements. These are balance sheet, income statement, and cash flow statement. If you're ready, let's get started. So what is accounting? If you go to Wikipedia, accounting is defined as the measurement, processing, and communication of financial information about economic entities. Accounting information is useful for many different parties. Shareholders and investors can use accounting information to predict future cash flows of a firm. Creditors can also use accounting information to understand liquidity, risk, and profitability of a firm. Employees can use accounting information to judge firms' financial stability as well as in negotiating their economic contracts. Customers can use accounting information to understand the firm is strong enough to cover its warranty. And finally, managers can use accounting information in their decision-making process and in negotiating their own compensation contracts. Now, it's a good time to differentiate between financial accounting and management accounting. Financial accounting deals with measurement and communication of financial information for external users. These external users include shareholders or investors, creditors, governmental authorities, or auditors. On the other hand, management accounting deals with measurement and communication of information for internal users. These internal users include managers and employees. So the bottom line is financial and management accounting deals with the measurement and communication of the same economic reality in different forms for different users. So, what is accounting information and how we can obtain this information? Let me start with the second question. There are many resources you can use to obtain accounting information. One very useful resource you can always use is firms' own websites. If you go to the website of any public firm, you are likely to see a link called Investor Relations. And if you click on link, you will get a lot of financial information about the firm. Here is an example. Here is investor relations website of Walmart. As you can see, you have access to information about recent stock price, business strategy, etc., etc. But what we are interested in is accounting information. And you can obtain accounting information about Walmart by clicking on two links on this website. These links are annual reports and SEC filings. Under annual reports, you will have access to annual accounting information for Walmart. On the other hand, under SEC links, you will have access to both quarterly and annual accounting information for Walmart. So now let me go to my first question. What exactly is accounting information? When somebody asks you this question, you need to always remember accounting information is major financial statements and also these major financial statements. The major financial statements are balance sheet, income statement, and cash flow statement. Now let's discuss in detail what kind of information we can obtain from these financial statements. The first and probably the most important financial statement is balance sheet. Balance sheet communicates information about assets, liabilities, and shareholders' equity of a firm. In other words, by looking at the balance sheet, you can have access to the resources of the firm to create value and how these resources are financed. These resources can be financed through liabilities, like a bank loan, or investment by shareholders. The second most important financial statement we are going to talk about in this class is income statement. Under income statement, you have access to revenues and expenses of a firm for a certain period of time. This certain period of time can be a quarter or a year. And finally, the third most important financial statement we are going to talk about in this class is cash flow statement. Cash flow statement describes in detail how cash changes for a firm for a certain period of time. This can be a quarter or a year. In particular, by looking at cash flow statement, you can understand the cash generated through operations, cash coming from investing activities, and cash provided by financing activities. One thing that you have to always remember about financial statements is that they are summary measures. There is just one number. If you want to have access to details on how those numbers are calculated, you have to look at the notes to these financial statements. Notes to financial statements describe in detail how the numbers on the financial statements are calculated. We said probably the most important financial statement is balance sheet. Balance sheet communicates information about financial position of a firm at a particular point in time. By looking at balance sheet, you have information about assets of the firm, liabilities of the firm, as well as shareholders' equity of a firm. In other words, balance sheet communicates information about resources of the firm and how those resources are financed. Assets, liabilities, and shareholders' equity constitute fundamental accounting equation. Under fundamental accounting equation, assets are equal to liabilities plus shareholders' equity. Or another way of saying is that under fundamental accounting equation, resources are equal to financing of those resources. Now, it's time to make an exercise about balance sheet. Here is the balance sheet of Walmart at the end of year 2014 and 15. Now, our task is to see whether fundamental accounting equation holds for Walmart. In particular, you need to check whether assets are equal to liabilities plus shareholders' equity for year 2015. Let's check. So, at the end of year 2015, total assets of Walmart is $203,706. One thing that I want you to pay attention here is that all of these numbers are in millions. So basically, the real amount of total assets for Walmart at the end of year 2015 is $203,706,000,000. But just to make our job easier, we are gonna not talk about millions. So at the end of year 2015, the total assets of Walmart is $203,706. Under fundamental accounting equation, this number should be equal to summation of liabilities plus shareholders' equity. And if you look to the second box on this slide, you are gonna see that total liabilities plus redeemable non-controlling interest plus equity, which is actually shareholders' equity, is again $203,706. So it looks like for Walmart at the end of year 2015, fundamental accounting equation holds. Now it's time to discuss the three important parts of a balance sheet. The first part of a balance sheet is assets. Under assets, you have access to resources of a firm to create value. Resources have three important features. Resources should be controlled by a firm, they should have probable economic benefits, and we should have sufficient reliability to estimate these future economic benefits. So what are some examples of assets? Cash is an asset of a firm. Another example of an asset is inventories. So what is an example here? For a car dealer, for example, the cars sitting to get sold are inventories, and they are a form of assets. Another example for assets is production machines. They are used to manufacture new goods. In general, we have two groups of assets. These are current assets and long-term assets. Current assets are the ones which have relatively short life. Here, what we are talking about is the cutoff here is 1 year. So if you are dealing with an asset who's going to stay on the balance sheet for less than 1 year, they are classified as current assets. Some examples are cash, inventories, and account receivable. So now let's very briefly discuss what account receivable is. So basically, suppose that a firm is selling goods to some customers, but the firm doesn't collect the payment yet. So then firm books these future payments from customers as account receivable. And most of the time, account receivables are collected from customers within a year. Therefore, they are classified as current assets. The second important group of assets we are going to deal with in this class are long-term assets. Long-term assets are the ones, they generally have a life more than 1 year. For example, buildings and equipment. If you have a building or an equipment, as a firm, you can use these assets for more than 1 year. Therefore, they're going to stay on your balance sheet for more than 1 year. Now it's the perfect time to do some exercises about assets. So the question here is, we are going to identify the values of the following accounts on Walmart's 2015 balance sheet. And if you want access to this balance sheet in real life, you can go to Walmart annual report. You can look at page 37. So what are the assets that we are searching on Walmart? We are going to search for cash, receivables, inventories, prepaid expenses, property and equipment, net. So how are we going to go through with this question? First, you will go to whole balance sheet of Walmart, and then you are going to zoom into assets section of Walmart. Now it's the time to search for those numbers for year 2015. The first asset we said we are going to search on Walmart's balance sheet is cash. For the year 2015, the amount of cash Walmart has on its balance sheet is $9,135. And let me remind you one more time, all of these numbers are in millions. Just to make our job easier, we are going to talk about these millions. The second group of assets that we are supposed to find on Walmart balance sheet for year 2015 is receivables. At the end of year 2015, the total amount of receivables Walmart has is $6,778. Let me define one more time what we are talking about as receivables. By account receivable or receivables, we are talking about sales made by Walmart but not collected yet. But notice that these receivables are classified as current assets. So basically, Walmart expects to collect from its own customers $6,778 by the end of next year. The third asset that we are supposed to find on Walmart balance sheet is assets. And the value for year 2015 is $45,141. So these are the total amount of inventories goods that are in Walmart superstores to be sold in the next year because they are classified as current assets. The fourth group of assets that we are supposed to find on Walmart balance sheet is prepaid expenses. And you find that this amount for year 2015 is $2,224. Now it's a perfect time to discuss what are we talking about as prepaid expenses. So most of the time, these prepaid expenses are about like insurance or rent. If some of this insurance or rent are paid in advance, suppose that Walmart is renting all of its superstores annually, and they pay all of the rent expenses at the beginning of the year. These are not expensed immediately. First, they are recorded as prepaid expenses, and they are expensed over time. We are going to have a special section on about prepaid expenses. So for now, all you have to know is these are prepaid expenses that's going to be expensed in the future. The last group of assets that we are supposed to find on Walmart balance sheet is property and equipment, and this value for year 2015 is a big number, $114,280. And this is expected for Walmart because they have a lot of stores, they have a lot of trucks, etc., and they are all classified under property and equipment. The second important category of a balance sheet is liabilities. Liabilities section provides information about obligations of a firm. For an obligation to be a liability, it has to have three features. First of all, these obligations should be about transferring economic benefits in the future. Second of all, obligations have to be measurable. And finally, the benefits which create these obligations have already been received by the firm. If we have these three features, then we are talking about liabilities which we can put on balance sheet. So what are some examples of liabilities? Probably the most important and common example of a liability is accounts payable. Suppose that Walmart, which is our example in this class, is buying goods from its vendors, but Walmart doesn't pay yet. Then Walmart has to create an accounts payable for future payment to these vendors. Another example of a liability is wage payable. Suppose that we have employees, they work for Walmart, but they are not paid yet. Whenever we understand they work for Walmart, we need to create wage payable to account for our future possible payment to these employees. And finally, debt is a very classical example of a liability. If Walmart goes ahead and borrows money from a bank, for example, they are going to be booked as a debt on liabilities section of a balance sheet. In general, we have three types of liabilities. These are current liabilities, long-term liabilities, and provisions. In current liabilities, we are talking about obligations that are supposed to be paid within a year. Accounts payable, wage payable are some common examples of liabilities that firms are supposed to pay within a year. On the other hand, long-term liabilities are obligations that are supposed to be paid in a time period more than 1 year. For example, if a firm goes ahead, borrows money, which is payable for the next 15 years from a bank, then they are booked as long-term liabilities. And the last component of a liability is provisions, which is quite interesting. Here we are talking about amounts where there is at least a reasonable certain that obligation will be incurred in some future date. So what's the idea here? Suppose that a firm is going through some lawsuit. It's quite possible that because of this lawsuit, firm can lose a lot of money as a penalty. If the keyword here is reasonable, if there is a reasonable certainty, then firm has to create a liability in the form of a provision for this possible future penalty associated with this lawsuit. And we are going to spend a lot of time on provisions in next lectures. Now it's the time to do an exercise about liabilities. Our job right now is to identify the values of the following liability accounts on Walmart's 2005 balance sheet. And again, if you want access to the real balance sheet for Walmart, you need to find Walmart annual report from its customer relations website, and then you need to open page 37. The liabilities that we are going to search on the balance sheet of Walmart are short-term borrowings, accounts payable, long-term debt due within 1 year, and long-term debt. For this purpose, we need to go to balance sheet of Walmart, and we need to zoom in liability section of this balance sheet. The first liability that we are supposed to identify on Walmart's balance sheet was short-term borrowings. And if you look at for year 2015, the amount of short-term borrowings Walmart has is 1,592. Just to remind you one more time, all of these numbers are in millions. The second liability that we are going to identify, its value is accounts payable. By the end of year 2015, the amount of accounts payable Walmart has is 38,410. In other words, Walmart purchased goods from its vendors by the end of year 2015, and they didn't pay yet. And the amount of this purchase of goods which are not paid yet, but they are payable within a year, because this is a current liability, is $38,410,000,000. The third group of liabilities that we are supposed to search on Walmart's balance sheet is long-term debt within a 1 year, and its value is 4,810. So this is interesting here. Let me just put a note here. Here we are talking about long-term debt, which is supposed to pay in more than 1 year, but we are just dealing with its current portion. So basically we have borrowed for a long-term debt, but now all we are dealing with within the next year. out of all of this long-term debt, we are supposed to pay 4,810 within the next year. That's why this is the long-term debt due within 1 year, or in other words, it's the short-term component of long-term debt. And finally, we need to find the value of long-term debt. For the year 2015, the amount of long-term debt Walmart has on its balance sheet is 41,086. The third section of a balance sheet is shareholders' equity. Under shareholders' equity, you can have access to information about investment of shareholders. If you remember fundamental accounting equation, assets were equal to liabilities plus shareholders' equity. Another way of defining shareholders' equity is the difference between assets and liabilities. So basically, assets constitute total resources of a firm. Some of these resources are financed through liabilities, and the rest is financed through shareholders' equity. In almost every shareholders' equity account, you have access to three major accounts. These are common stock, additional paid-in capital, and retained earnings. Let me start with the common stock. If you are a shareholder of a firm, you are likely to get a share certificate. In that share certificate, it tells you that you have one share of a public firm, and most of the time, that share certificate also provides you a value on it. And these values are generally quite small, like 1 cent, $1. And basically, in the common stock section of a balance sheet, we see these nominal par values, these small values written on the share certificates, times number of shares printed by the firm over time. The second important section of a balance sheet is additional paid-in capital. When investors are purchasing shares, they do not pay just nominal value of the firm. Most of the time, they pay much more than that. So the extra money they pay to acquire share of a firm is recorded under additional paid-in capital. And lastly, the third important section of any shareholder's equity is retained earnings. Here you have information about profits accumulated over the years but not distributed to shareholders. Firms earn money throughout the years. If they do not distribute this money to shareholders in the form of dividends, they are recorded under retained earnings. Now it's the perfect time to do an exercise about shareholders' equity section of a balance sheet. Our job is to identify the values of the following accounts in Walmart's 2015 balance sheet. These accounts are common stock, capital in excess of par value, or it can be considered as additional paid-in capital, and finally, retained earnings. For this purpose, you need to go to balance sheet of Walmart, and you need to zoom in shareholders' equity section of Walmart. And we need to find the values of these three accounts for the year 2015. The first account that we were supposed to find on Walmart balance sheet was common stock. For the year ended 2015, the amount of common stock Walmart has is 323. The second account that we are supposed to identify its value on Walmart balance sheet was capital in excess of par value. As I mentioned before, this can be considered as additional paid-in capital. For the year ended 2015, the amount of additional paid-in capital is 2,462. The last account that we are supposed to identify its value on Walmart balance sheet is retained earnings. For the year ended 2015, the amount of retained earnings for Walmart is 85,777. Let me remind you one more time, all of these numbers are in millions. In other words, by the end of year 2015, Walmart has earned about $86 billion, but they didn't distribute this money to its own shareholders as a form of dividends yet. In other words, Walmart is sitting this much of profits on its balance sheet. The second major financial statement we are going to discuss in this class is income statement. By looking at income statement, you have access to financial performance of a firm over a certain period of time. Most of the time, this period of time is a quarter or a year for a public firm. Income statement summarizes information about firm's revenues, expenses, gains, and losses within a certain period of time. If you look at the income statement, you are going to have access to the following information. you will have access to sales of a firm. Sometimes sales is considered as revenues or turnover, depending on the firm. The second important piece of information you will have access to by looking at income statement is cost of sales. So what is cost of sales? Suppose that we are talking about a car dealer. When they sell a car, they book it as a sales or revenues. The cost of this car, basically the car dealer's payment to car manufacturer to acquire this car, is considered as cost of sales. The third important group of information we are going to access by looking at income statement is operating expenses. These operating expenses include, for example, payments to salespeople, rent expense for the showroom, etc. These are expenses that you pay as a part of your normal business operation. If we go to car dealer example, car dealer doesn't earn money just by selling the cars. They can make money from some other activities. Suppose that they have lots of cash. They deposit this cash into a bank account, which generates some interest income. This interest income is considered as other income. Basically, under this category, we are talking about incomes or expenses of a firm which is nothing to do with their main core operations. Finally, we will have information about income taxes for a firm if you look at income statement. From time to time, very rarely, income statement also include information about extraordinary gains and losses. As you can understand from the names, these are gains or losses very rarely happening to public firms. What is an example? Suppose that a public firm is in a location which goes through some form of earthquake, and the losses associated with the earthquakes are considered as extraordinary gains and losses. However, most of the time you will not find this information, because for something to be an extraordinary gain or loss, they need to come from some very rare events. Now it's the perfect time to go through the income statement of Walmart. Our job is right now to identify the values of the following accounts from the Walmart's 2015 income statement. So what are the accounts we are looking for? Total revenues, cost of sales, operating income, and net interest income. For this purpose, we need to go to income statement of Walmart, and now let's identify those numbers. The first value that we are supposed to identify on Walmart's income statement was total revenues. For the year ended 2015, annually, the amount of total revenues for Walmart is $485,651. Again, let me remind you one more time, these numbers are in millions. So basically, by the end of year 2015, for year 2015, the amount of revenue for Walmart is about $486 billion. The second important piece of information you are supposed to identify from Walmart's income statement is cost of sales. So basically, we are talking about the cost of the inventory. If the Walmart is buying, for example, some gums to be sold, what is the cost of these gums to the Walmart? And the amount of cost of sales for Walmart is about $365,086. The third important information that you're supposed to identify from Walmart's income statement is operating income. For the year ended 2015, the amount of operating income for Walmart is $27,147. And lastly, the amount of net interest expense is $2,348. Please note that most of this interest expense comes from debt-related interest expense, and its amount is $2,161. So one might ask, how do I understand that interest net is an expense? Please note that operating income is $27,147 and income from continuing operations before income taxes is $24,799. Therefore, it must be the case that interest net, which is the number in red rectangle here, must be an expense. The third important financial statement we are going to cover in this class is cash flow statement. Under cash flow statement, you have access to cash inflows and outflows of a firm over time. Just like income statement, this time period is generally a quarter or a year. In other words, cash flow statement summarizes how cash change for a particular firm over this period of time. Cash flow statement has three major parts: cash flows generated from operations, cash flows generated from investing activities, and cash flows provided by financing activities. So let's see these numbers in detail. We said cash flow statement summarizes how cash changes for a public firm over time. And let's see how this works in reality. Here is the Walmart's cash flow statement for the last 3 years, 2013, 14, and 15. Let's zoom into 2015 and let's look at the numbers in the box. The first number I want to attract your attention in that box is net increase in cash and cash equivalents for year 2015. And this amount is 1,854. In other words, in year 2015, net cash generation by Walmart is 1,854. Okay. The second important number in this box is cash and cash equivalents at the beginning of the year. So basically, at the beginning of year 2015, the amount of cash Walmart has in its bank account is 7,281. So you have now access to amount of cash at the beginning of the year. You now know the amount of cash generating during the year 2015. Now you can calculate the amount of cash sitting in the bank account of Walmart at the end of year 2015, which is 9,135. We said cash flow statement has 3 major parts. These are cash flows from operations, cash flows provided by investing activities, and cash flows provided by financing activities. Now let's go through these numbers in detail. The first and probably the most important component of a cash flow statement is cash flow provided from operations. For Walmart, for the year 2015, the amount of cash flow from operations is 28,564. In other words, for the year ended 2015, Walmart has generated from its own core operations about $29 billion of cash. That's a big number. Okay, the second component of a cash flow statement is cash flows provided by investing activities. And if you look at for Walmart for year 2015, this number is 11,125. Now there's something very important here. Notice that that number is in parentheses. In accounting, if a number is in parentheses, it means that it is negative. In other words, Walmart's cash flow from investing activities in year 2015 consumed about $11 billion. So where exactly spent this money? If you go to details in investing section, you are going to see that most of these numbers are spent on just one thing. This is payment for property and equipment. In year 2015, Walmart has spent about $12 billion to acquire new property and equipment for their own operations, and therefore we have a huge negative number under cash flow from investing activities. The third important component of a cash flow statement is cash flow from financing activities. For the year ended 2015, cash flow from financing for Walmart is minus, because it is in parentheses, 15,071. So where is this negative number coming from? If you look a little bit on details, we see that there are 3 major reasons why we have a big negative number either under cash flow from financing activities. The first one is net change in short-term borrowings. For the year ended 2015, Walmart has paid $6,288 to pay for their short-term borrowings. The second big negative number under cash flow from financing activities is payments of long-term debt. To pay for long-term debt, Walmart has paid $3,904 for year 2015. And finally, again for year 2015, Walmart has paid $6,185 for dividends. These are dividend payments to its own shareholders. And because of these 3 big negative numbers for the year ended 2015, we have 15,071 negative cash flow from financing activities. So if you sum these 3 numbers, cash flow from operations, cash flow from investing activities, and cash flows provided by financing activities, you are going to find net change in year 2015, and this number is 1,854. We said cash flow statement summarizes how cash changes between 2 time periods. Now let me just go back to balance sheet of Walmart, and this is something we have discussed. And I want you to attract your attention to cash and cash equivalents between year 2014 and 15 for Walmart. At the end of year 2014, the amount of cash Walmart has in its bank account is 7,281. For the year ended 2015, the amount of cash is 9,135. If you just go back to the original slide, these are the numbers that we see on the original boxes at the end. So we exactly explained how cash changes for Walmart between year 2014 and within 2015. And we said that there is a cash change between year 2014 and 15 due to these three reasons. There is a huge cash generation from operations, but this cash generation is spent by cash flows from investing activities because we acquired new property and equipment, and then we pay to our debt holders as well as shareholders. And therefore, net change in year 2015 is 1,854. This concludes our fourth module. In this module, we learn about the definition and uses of financial accounting information. We also went through in detail main financial statements. In the next module, we are going to learn how to record financial transactions, and we will learn how to prepare basic financial statements. Until that time, take care. Now, it's a good time to apply what we have learned during the class. At the end of every module, I'm going to use real company financial statements to show you practical applications of the course content. Before you go through these cases though, these cases have already been uploaded on Coursera. Please download them, spend some time to working on them, and then please watch the solution video. Please do not watch the solution video without going through these cases. You are going to get the maximum benefit. First you study and then come back to solutions. Let's get started. Here is case number 1. It is about General Mills annual report, and the first question is, what are the main components of General Mills annual report? Well, we have financial summary on page 10, selected financial data in page 12, management discussion of analysis of financial condition and results of operations, page 13, non-GAAP measures, page 35. Let me just pause you a little bit. By non-GAAP measures, I'm talking about accounting numbers, but they are not defined within the accounting. For example, if you look at income statement at the end of every quarter or a year, there is a net income number. But under non-GAAP measures, what companies do is that, look, we have this income number, but this income number doesn't reflect our reality. For example, it's quite possible that during the year there's an earthquake. This earthquake costs some money, and it is reflected on net income. Companies can take away this loss associated with the earthquake to give you, according to their measure, a better measure of net income. So by non-GAAP measures, we are talking about accounting numbers, but they are not according to accounting precisely. So they can take away some of the expenses or some other items. If you continue, on page 45, we have reports of management and independent registered public accounting firm. On page 47, we have consolidated financial statements, and this is basically what we have in their annual reports. And most of the time, from an accounting perspective, what we are interested is consolidated financial statements, which includes income statement, balance sheet, cash flow statement, and statement of equity, and then some footnotes, that is financial statements. And for General Mills, this starts in page 47. Here is the second question of first case about General Mills. The question is asking you, what are the General Mills' 3 largest assets? Well, if you go to balance sheet, if you look at the asset side, you are going to see that these are goodwill, other intangible assets, and land, buildings, and equipment. So let's just see them in action. Here is the balance sheet of General Mills, and these 3 assets are in red rectangle. We have goodwill, other intangible assets, land, buildings, and equipment. Here is the third question of case number 1. Would you expect these to be General Mills' main assets given the nature of its business? It's not surprising that goodwill and other intangible assets are the largest assets given the nature of General Mills' business. The other intangible assets include brands, franchise agreements, customer relationships, which I'm going to show you soon on note 6, that most of these other intangible assets includes brands. It is also not surprising that lands, buildings, and equipment is a large asset for this company because this is a food manufacturing company. So let me show you note number 6, where we have a decomposition of goodwill and other intangible assets. Here, if you look at carefully, we have a big chunk of brands. This is a food manufacturing company like cereals, and we have, when we are buying the cereal companies from some other firms, we buy also their brand names. We also have some franchise agreements. Basically, we have some franchisees, and this also constitutes a large chunk of our assets. What are the two largest liabilities? These are long-term debt and accounts payable. And I got this information from page 48 of the consolidated balance sheet. If you want to see it, here is consolidated balance sheet, page 48. I'm looking for two large liabilities. The largest liability here is long-term debt, and the second largest liability here is accounts payable. They are both in red rectangle. What type of obligations are represented by these liabilities? So what is basically included in here? The long-term debt consists mainly of notes payable, which I'm going to show you soon in note 8, debt. And then accounts payable most likely consists of amounts due to suppliers, given the nature of General Mills business. Let me start with note 8. So if you look at note 8, here is a decomposition of all that long-term debt. These are long-term notes, bonds, which we are going to cover when we are talking about liabilities. And for accounts payable, as you can understand from the name, these are payables to our suppliers. So basically we buy goods from them, but we don't pay cash right now, and they become accounts payable. What is the value of shareholders' equity? The total shareholders' equity, or you can call this as stockholders' equity, is equal to 4,327.9 in million. And where did I get this information? Of course, I got this information from consolidated balance sheet. As you can see, the amount of total shareholders' equity is in red rectangle. The amount is, one more time, 4,327.9. It is coming from consolidated balance sheet. Here is question 7 of case number 1. What is the value of net sales for fiscal year 2017? Of course, we are going to get this information from income statement, but General Mills called this statement as consolidated statement of earnings. It's the same thing. The amount of sales in year 2017 is how much? 15,619.8 in millions. So if you look at income statement or consolidated statement of earnings, this is the first number. It's called net sales. Its amount is, one more time, 15,619.8. Question number 8 of the first case is asking you, what was the net income or net earnings? They are the same thing for fiscal year 2017. Again, we are going to get this information from income statement, which I'm going to show you soon. This amount is 1,701.1 million. So here is the income statement. There's a line called net earnings. It is in red rectangle, and it says that the amount of net earnings is 1,701.1. What does the net income number represent? So basically the question asking you, how did we come up with this net income number? So what are the revenues, what are the expenses, and how we basically ended up with this number? In other words, the question is asking you to summarize what you see on the income statement. Let me summarize with words, and if you go and check this with the income statement, these are basically what is going on. Net earnings measures the financial performance of General Mills over the past fiscal year. For General Mills, net earnings is net sales plus any divestiture gains. You don't have to know what divestiture is, but for now all you need to know is sometimes we sell some of our businesses. When you are selling or getting rid of your business, it can cost you some money. Sometimes you make money out of this. So this process is called divestiture. If you make money, you have a divestiture gain. If you lose money when you're getting rid of a business, then it's going to be a divestiture loss. And then in other revenues, we have after-tax earnings from our joint ventures. Basically, we have some businesses, 50-50 businesses with some other firms. And here is the money that we make from these joint ventures. Less, okay, these are all our revenues. What type of expenses do we have on the income statement? You are going to see that there is cost of sales, SG&A expenses, divestiture loss. Maybe we have some businesses we sold, but we made a loss. Restructuring, impairment, other exit costs, they're also similar. Again, we are just getting rid of some businesses. and then we pay net interest. It can be positive or negative. Sometimes there is an interest expense, sometimes there is an interest gain, and finally you pay income taxes. And here is the 10th question of case number 1. Where can you learn how the company accounts for inventories? So I'm asking you, how do we know what kind of inventory accounting method this company uses? Most of the time, almost all of the time, we learn the accounting for certain assets and liabilities by looking at notes. It can be generally either note number 1 or note number 2. So here in notes to the consolidated financial statements, note 2, summary of significant accounting policies, inventories on page 51 summarizes out what kind of inventory method they are using in general mills. And here is the note number 2, summary of significant accounting policies. There is a paragraph just for the inventories. So what does it say? It says all inventories in the United States other than grain are valued at the lower of cost using the last in first out method. This is very normal. This is a US firm. US firms use LIFO, which we are going to cover in week number 4 when we are talking about inventories, so you don't have to know what it is. This is quite standard for a US firm, or they are using market value of these inventories. Grain inventories are valued at net realizable value. Again, we are going to cover this in week number 4. The point I'm trying to make here is that if you want to learn the exact accounting method for different groups of assets and liabilities, you got to look at the notes to financial statements. Most of the time, this note is either number 1 or number 2. What are the main components of general mills inventories as of May 28, 2017? Please quantify. So I'm asking you, when I look at inventory number on balance sheet, I see a summary number. I'm asking you the components. So where is this inventory number coming from? What kind of inventories we have? Well, we have raw materials and packaging. Its value is at $395.4 million. We have finished goods. So these are goods ready to sell, 1,224. And we also have grain. It's like another form of raw material. It is 73 million. So where did I get this information? I get this information from footnote number 17, supplemental information. It is on page 86, which I'm going to share it with you. Here for years 2016 and 17, I share with you what are the balances of raw materials and packaging, finished goods, grain. There is a line called excess of FIFO over LIFO costs, which you don't have to know for now. I'm going to explain this in week number 4. And at the end, we have the total amount of inventory at the end of year 2017. It is 1,483.6. If you compare this number with the balance sheet, it should be the exact number. Now, let's go to our case number 2, where we are asked to classify the following items as an asset, liability, or shareholders' equity for a sporting goods company. Retained earnings, it is equity. Income tax receivable, it's a receivable, therefore it's an asset. Other long-term debt and leasing obligations, it's a liability. I'm going to cover leasing when we are talking about liabilities. Inventories, we have just discussed, it's an asset. Prepaid expenses is an asset. Prepaid expenses means sometimes, for example, we pay the rent in advance for the next year. That's what we mean by prepaid expenses. When you pay, yes, cash goes down, but it doesn't mean it's an expense because you didn't rent this facility yet. Once you start using this facility, it can be expensive. It can be expense. By the time that you are going to use this facility, the prepayment is an asset. Accounts payable is a liability. Additional paid in capital is an equity. Income tax payable, liability. Account receivables is an asset. And common stock is a part of shareholders' equity. Now, I'm going to move to our case number 3, where we are going to classify each of these items for a coffee firm. What's the first item here? An agreement to hire one person to work as a server. So, is this accounting? The answer is no. You just basically, verbally or contractually, you sign an agreement with somebody so that somebody will work for you as a server. You didn't pay any money. They didn't start working for you. They didn't provide you any service. Therefore, from an accounting perspective, nothing has happened. Therefore, if you look at the first line, we don't have anything associated with this. I'm not gonna record this at all. Item number B here, a roasting machine used to roast coffee beans. Okay, what is the nature of this machine? From an accounting perspective, it's a fixed asset. We are gonna cover fixed assets in week number 5 in my advanced course, where we are gonna see that these are assets which are gonna have life more than 1 year, and this is a machine, it has a life more than 1 year, therefore it's gonna be a fixed asset. Item number C here, utilities for the current month payable next month. One more time, utilities for the current month payable next month. So what is the nature of this? This is going to be a current liability. So we use this utility, we owe money to utility company, which we are going to pay in the next month. Therefore, it's a liability. Since we are going to pay next month, it is less than 1 year. Therefore, it's also a current liability. Item number D, $4,000 in cash on hand. Cash is an asset. It's generally a current asset because we can easily spend this money. Therefore, it's going to be a current asset. Item number E here, $1,000 shares of common stock. What is the nature of this in terms of accounting? It's going to be part of shareholders' equity. When you print shares, it's going to be included in your shareholders' equity. 50,000 kilograms of coffee beans. I have some coffee beans, either roasted or unroasted. What is the nature of this in terms of accounting? It is going to be inventories. It can be a raw material, okay, or it can be finished goods inventory. Inventories are generally current assets, okay. Most of the time you are going to sell these beans within a year, therefore it's current assets. If you are going to tell me that, look, this is a coffee beans I'm going to hold on to for 10 years, then it can be a long-term asset. But for now, most of the time coffee beans are roasted and sold within a year, therefore it's a current asset. The next item here is an invoice from the main supplier of coffee beans. So this is my supplier of coffee beans. It looks like that they supply me some beans and then they send me an invoice. What is the nature of this in terms of accounting? It's going to be current liability. This is accounts payable. When accounts payable are most of the time paid within a year, therefore it is accounts payable. And finally, we have a bank note due in 3 years. So we borrow money from a bank which is going to be payable after 3 years. It's a liability, there is no question about this. Since it's going to be paid after 3 years, it's going to be a long-term liability. Now I'm going to move to my case number 4. As you're going to notice, case number 4 is kind of a repetition of case number 1, but the difference here is that we are going to use British Petroleum's annual report. And I value this exercise a lot. Why? Here's the deal. In accounting, at the end of the day, most of the companies provide more or less the same amount of information. However, the presentation of the information can be different. But the presentation can be especially different if we are talking about a firm which is not from the United States. That's why I choose British Petroleum quite intentionally. I want to show you their annual report and financial statements. You're going to see that the information is very similar. But the format is sometimes quite different. So here is the first question of case number 4. What are the main components of British Petroleum's annual report? Well, this is long. Okay, let me just look at the first part. We have a strategic report which includes chairman's letter, chief executive's letter, BP's investor proposition, sustainability, group performance, etc. There is a second big section which includes corporate governance, where we have committee reports, we have directors' remuneration report. This is especially a big deal in Europe, where they are talking a lot about how much they pay to their executives, how to justify that payment. And then we are interested in, of course, from an accounting perspective with financial statements. First, we have independent auditors report, where some auditors come and check the financial statements and they say that, look, this is okay with respect to current accounting rules. And then we have income statement. We have comprehensive income, which I'm going to cover later. We have statement of changes in equity on page 131. We have a balance sheet, cash flow statement, and then starting with page 134, we have notes. As you see, the format is similar. It's a little bit longer, this one, but it more or less covers the same information, just like the general mills in the first case. And then we also have some additional disclosure and shareholder information. So this is a long report. It's more than 300 pages. Here is the question number 2. What are the British Petroleum's 3 largest assets? These are property, plant and equipment, trade and other receivables, and cash equivalents. And of course, where did I get this information? I got it from balance sheet. So let me share it with you. Here are 3 large assets. They are in red rectangle. Let's just go over them one more time. What are these? Property, plant, equipment, trade and other receivables, cash equivalents. And the third question of the 4th case is asking you, would you expect this to be British Petroleum's main assets given the nature of its business? It's not surprising that plant, property and equipment, which includes oil and gas properties, plant and machinery equipment, oil deposits, storage tanks, service station, is the largest asset given the nature of British Petroleum's business. This is a company which is in the business of drilling for oil. Therefore, it's quite normal that they have a huge amount of plant, property and equipment. Question number 4 is asking you, what are the 2 largest liabilities? We have finance debt. It is non-current. Basically, it's a long-term finance debt. And then we have trade and other payables. And I got, again, this information from balance sheet, which I can share with you. Here are the 2 largest group of liabilities. Finance debt, it is under non-current liabilities. And we have trade and other payables, which is in current liabilities. What type of obligations are represented by these liabilities? The finance debt consists mainly of long-term borrowings, and I got this information from Note 26, finance debt. Trade and other payables, which is Note 22, consists primarily of trade payables, amounts payable to joint ventures and associates, payables for capital expenditure and acquisitions, payables related to the Gulf of Mexico oil spill. Finally, we have sales tax payables, custom duties, production taxes, and social security. Here is Note 26, where we see the details of the finance debt. You are going to see that most of these are borrowings. And if you look at Note 22, we see the details of trade and other payables. But the moral of this question is that if you want to learn more about the components of any of the numbers that you see on the balance sheet or income statement, you got to look at the notes. A lot of people do not look at the notes as much as they should, but devil is in the detail. And the detail can be learned only going through the notes. Question number 6. What is the value of shareholders' equity? Total shareholders' equity, which is called total equity for BP, is 101,548. Again, I got this information from balance sheet. As you can see here, it is the balance sheet shareholders' equity side, and this number is in red rectangle. What is the value of sales and other operating revenues for fiscal year 2018? That number is 298,756 in millions. Where do we get this information about sales? Of course, we get this information from income statement. If you look at the income statement, that's the first number. What was the net income for fiscal year 2018? So I'm asking you the bottom line, net income for 2018. We get this information again from income statement, and that number is 9,578 in millions. Here is the income statement. There is a line called profit or loss for the year. It is 9,578. And the 9th question of this case is asking you, what does the net income number represent? Profit measures the fiscal performance of British Petroleum over the past fiscal year. For British Petroleum, profit is sales and other operating revenues after interest and tax earnings from joint ventures and associates, gains, interest and other income minus purchases. Purchases, if you look at the income statement, it looks a little bit complicated, but purchases basically means cost of goods sold. Production and manufacturing expenses, production and similar taxes, depreciation, depletion, amortization, impairments, exploration expenses, finance costs, basically this interest, and income taxes. And the 10th question of this case is asking you, where can you learn how the company accounts for property, plant, and equipment? Again, we are asking you just the accounting for PP&E. As I said, most of the time you are going to learn this information from either note number 1 or 2. For BP, it is note number 1. There is an item called significant accounting policies, judgments, estimates, and assumptions, and you look at property, plant, and equipment paragraph. Here is property, plant, and equipment paragraph. They tell you in detail how do they do the accounting. For example, they say PP&E is stated at cost, less accumulated depreciation, accumulated impairment losses. So there is nothing particular here. This is quite normal. We are going to cover PP&E in week number 5. And then we have 11th question here. What are the main components of British Petroleum property, plant, and equipment as of December 2018? Please quantify. And the question is particularly asking you use the net book amount. Book means balance sheet. So I'm asking you just look at the balance sheet or the notes of balance sheet. And according to what is written over there, can you tell me what are the main components of plant, property, and equipment? Well, if you look at it, pay note 12, property, plant, and equipment, we have oil and gas properties. Its amount is $99,010. We have plant, machinery, and equipment. We have all deposits, storage tanks, and service stations, land and rent improvements, transportation, buildings, fittings, fixtures, and office equipment. As I said, you get all of this information by looking at note 12. In note 12, we have, in the first half, we have the cost of this asset. In the next half, we have the depreciation of these assets. As I mentioned, we are going to talk about this plant, property, and equipment in my advanced course. And this finishes the cases for module number 1. I hope you find it useful. To get the maximum benefit out of these cases, I strongly recommend, before you go through the solutions, definitely download the question document, spend some time on it, and then come back and watch the solutions video. This way you are going to get the maximum benefit out of these cases.
The University of Illinois was formed about 150 years ago with a land grant mission to democratize education. The IMBA is a testament to that mission. We are about access to education. We are looking for talented people around the world across a variety of socioeconomic backgrounds and demographic characteristics to constitute our classes because we believe the heterogeneity in background, heterogeneity in talented people will be fantastic for the IMBA, not only in terms of our visibility, but also in terms of enhancing the experiences of our students. And so what we have done is we are providing the opportunity to people around the world, talented people around the world, to complete a high-quality MBA education for about $20,000. So if you are talented and if you are eager to grow, then we want you to be a part of the University of Illinois family.
Hello, welcome to second class of Financial Accounting Foundations here at University of Illinois. Today we are going to talk about recording financial transactions and preparation of financial statements. Here is a brief overview of what we are going to do today. First, we will see the principles and some examples on how we record financial transactions. In other words, how we write financial transactions in accounting language. And then from these recorded financial transactions, we will learn how to prepare balance sheet and income statement. What is the guiding principle behind recording financial transactions? To understand this, we need to go back to fundamental accounting equation. Under fundamental accounting equation, total assets are equal to total liabilities plus shareholders' equity. Therefore, it must be true that for a certain period of time, let's say for a year, changes in total assets are equal to changes in total liabilities plus changes in shareholders' equity. So here in this formula, the delta stands for change. And this is true for any time period. Basically, for example, for a 5-year period, if there is an increase in total assets of $1,000, it must be the case that within this 5-year period, either total liabilities or shareholders' equity or a combination of them should increase by $1,000. And this constitutes the main logic behind recording financial transactions. So, how are we going to do the financial transaction recording? First, we are going to identify the accounts impacted by this financial transaction, and then we will worry about the amount that we need to record for these accounts, and finally, we have to ensure that fundamental accounting equation holds. So total assets must be equal to total liabilities plus shareholders' equity. Here is a small example. We have a firm here purchasing a truck for $65,000 using a bank loan. So let's go through a step-by-step how we are going to record this individual financial transaction. The first step is this transaction impacts which accounts? Well, we are buying a truck, which is a fixed asset. So basically, assets will go up. And secondly, we are buying this truck by getting a bank loan. Bank loan is a liability, therefore there will be also an increase in liabilities. The second step in recording financial transactions is what is the amount? No wonder it is about $65,000, and therefore because of this transaction, what's going to happen? Assets, in particular fixed assets, will go up by $65,000, and liabilities, in particular bank loan, will go up by $65,000. The third step is you have to ensure that fundamental accounting equation holds. Total assets increase by $65,000, and at the same time total liabilities also goes up by $65,000. There is no change in shareholders' equity, and yes, fundamental accounting equation holds. From now on, in order to record these individual financial transactions much more systematically, we are going to use something called transaction worksheet. So here is an example of what it looks like. In the transaction worksheet, we have assets equal to liabilities plus shareholders' equity. This is our fundamental equation. And then we have opening balances. Most of the time, whenever you start a year or a quarter, most of the accounts you have on the accounting system have beginning balances. And then there will be a bunch of transactions within that time period. Again, it can be a quarter or a year. And at the end of this time period, we are going to sum opening balances as well as the transactions within that time period so that we can come up with closing balances. So if we go back to our example 1, a firm purchases a truck for $65,000 using bank loan. How are we going to record this on the transaction worksheet? There will be an increase in assets, in particular fixed asset of $65,000, and then there will be an increase in liabilities of $65,000 in the form of bank loan. You have to always ensure that fundamental accounting equation holds. Total asset increased by $65,000 and total liabilities also increased by $65,000. There is no change in shareholders' equity, and yes, fundamental accounting equation holds. Let's do one more example. A firm sells goods which originally cost $1,000 for $1,500 in cash. What was the first step of recording this financial transaction? First, which accounts are impacted? But it looks like we are making a sale in cash, so cash will be impacted. Second of all, we are making a sale, so revenue will be impacted. And then we are selling a good, so we don't own this good anymore. So inventories will go down, and then this inventory decrease will be recorded as expenses. So let's record this. What's the first step of recording this transaction? You are making a sale of $1,500 in cash. So assets, which in particular cash, will go up by $1,500, and revenues will also go up by $1,500. Let me mention something very important here. Revenues or expenses will be represented in income statement, and income statement is represented on transaction worksheet under shareholders' equity. We are going to go through this in detail later, but for now, you need to remember that any account which impact income statement will be represented under shareholders' equity or for transaction worksheet. What is the next stage? We are selling some goods which originally costed $1,000. Therefore, there will be a reduction in inventory, which is an asset account of $1,000, and then there will be a recording of a cost of goods sold or an expense on income statement of $1,000. So what was the third step? You have to ensure that fundamental accounting equation holds. The net change in total assets for this transaction is $1,500 minus $1,000, which is an increase of $500. And what is the net change in the liabilities plus shareholders' equity sides? It is again plus $500, and yes, fundamental accounting equation holds. Here is another example. A firm receives a utility bill for $850. So what was the first step of recording this transaction? Which accounts are impacted? Well, we are getting a utility bill. It's an expense, so it's going to impact income statement, which is a shareholder's equity item. But are we paying for this bill? Not really. All we are doing is we are getting the bill. Therefore, we are going to getting the notice to pay this thing in the future. Therefore, it's going to be recorded as a liability. It's going to be recorded as a payable. So how are we going to record this transaction? There will be $850 on shareholders' equity, which is the expense associated with income statement. Notice that this number is in parentheses. Parentheses represent in accounting negative number. And similarly, we are not paying this bill. All we are getting is the notice of paying this bill. Therefore, we are going to record the liabilities of $850. It's a liability. It's a positive number. What was the next step of recording financial transactions? You have to ensure that fundamental accounting equation holds. The net change in total assets associated with this transaction is 0. And what is the net change in liabilities plus shareholders' equity? There is a positive $850 for liability increase, and then there is a loss or expense recording of $850 under shareholders' equity. Net liabilities plus shareholders' equity changes by 0, and therefore fundamental accounting equation holds. Now, what we are going to do is that we are going to go through a long example to ensure that we are very comfortable with recording financial transactions. Hello again. In the first video, we talked about 3 examples on how we are recording individual financial transactions. Now, we will go through a comprehensive case which involves recording of a lot of financial transactions as well as preparation of balance sheet and income statement to make sure that we are comfortable with this topic. Here is our comprehensive case. Jack sets up a supermarket on January 1st, 2016, which sells groceries in Central Illinois by investing $15,000 of his own money and getting a bank loan of $30,000. This bank loan is for 6 years and it has an annual interest rate of 10%. In the first year of its operations, these are the individual financial transactions for the supermarket. There is a purchase of a shop. They purchase groceries. There is an annual insurance premium payment. They sell some groceries. There is a payment to creditors, payment to utilities, payment to employees, and payment of annual interest for the bank loan. So how are we going to record these transactions? First, we need to go back to our transaction worksheet. And that is what it looks like. Assets are equal to liabilities plus shareholders' equity. Under assets, I'm going to use 3 individual accounts. These are cash, inventories, and PP&E. PP&E stands for plant, property, and equipment. The second part of this transaction worksheet is liabilities. Over there, I'm going to use accounts payable and bank loan as individual accounts. And finally, under shareholders' equity, I'm going to use common stock, income statement, and retained earnings. So let me record the first transaction first for you. At the beginning of year 2016, Jack sets up this supermarket by investing $15,000 of his own money. So there is a cash inflow to the supermarket. Cash goes up by $15,000. Just to ensure that there is not a lot of numbers over there, I just record 15. Okay, where is this money coming from? Well, it's coming from Jack, who is owner of this supermarket. We record investments of shareholders under shareholders' equity, in particular under common stock. So basically, if there is some cash infusion by the shareholders to the firm, it's going to be recorded as an increase in common stock. And therefore, notice that shareholders' equity, in particular common stock, also goes up by $15,000. I'm going to stop here. You have the individual transactions. You have transaction worksheet. Now please take a pencil and paper, go through all individual transactions by yourself. And then we will go through this question together just to ensure that your answers match the correct solutions. Are you ready? Then let's get started. What is the second individual financial transaction we are supposed to record? Jack sets up the supermarket also by getting a bank loan of $30,000. Therefore, cash goes up by $30,000 and bank loan, which is a liability account, goes up by $30,000. Again, whenever we are recording an individual financial transaction, you have to always keep in mind that fundamental accounting equation holds. Notice that total assets goes up by $30,000 because of this transaction, and total liabilities also goes up by $30,000. So we are okay. So what's the third financial transaction? This supermarket purchased a shop by paying $10,000 in cash. So therefore, cash will go down by $10,000. Notice that the number is in parentheses, so it's a negative number. And then the supermarket is purchasing a shop. This is going to be recorded as a plant, property, and equipment. And notice that PP&E goes up by $10,000. What is the next financial transaction? We are going to buy some groceries to be sold in the future. Are we paying for these groceries? Not really. We are buying these groceries in credit. Since you are buying these groceries, they are going to be recorded as inventories. There will be an increase in inventories of $5,000. Since we are not paying for these groceries, accounts payable will also go up by $5,000, which is a liability account. Accounts payable account is generally used for purchase of goods and inventories, but we are not paying yet. What's the next step? The next step is payment of annual insurance premium of $1,000. Since you are paying annual insurance premium, there will be a cash decrease of $1,000. And then we are going to record this insurance premium as an expense. Therefore, it's going to show up in income statement. And as we have went through in first video, whenever there is a change on the income statement, it's going to be represented in our transaction worksheet under shareholders' equity. And notice that there is an expense. It's a negative number, 1,000. What's the next one? We are going to make a sale of $5,000 in cash, and then these goods that we are selling in this transaction originally costs us $3,000. So let's go step by step. We are making a sale of $5,000. Cash goes up by 5. And at the same time, revenues, which is an income statement item, also goes up by 5,000. What is the second leg of this transaction? These goods that we are selling in this transaction originally costed us $3,000. Therefore, there is a reduction in inventories of $3,000. And then this reduction will be also recorded as an expense, as a cost of goods sold in particular, under income statement. Again, $3,000. The next step, we are going to pay our creditors $4,000. Since you are paying, there will be a cash reduction of $4,000. And at the same time, you are paying to your own creditors. Basically, we are talking about accounts payable. These were the people, these are our vendors who provide the goods and services that we can sell in our supermarket. Since we are paying to them, we don't owe them any more money. There will be a reduction of $4,000 from accounts payable. The next step is we are going to pay utilities. Therefore, and the amount of these utilities is $2,000. Cash will go down by $2,000. At the same time, it's going to be recorded as a utility expense under income statement. The next one is we have some employees who work for us and they need to be paid. There will be a cash reduction of, again, $2,000. And then I'm going to record this as a wage expense in income statement. And finally, we are supposed to pay our annual interest expense for the bank loan we got when we were setting up this shop. What do we know about this bank loan? The original amount is $30,000. Annual interest rate is 10%. $30,000 times 10% is $3,000 annual interest expense. Since you are paying for this, cash will be decreased by $3,000. It's going to be recorded as an interest expense on income statements. So we are going to do something here very important. We are done with recording our financial transactions. When you are done with recording your financial transactions, at the end of every time period, which can be a quarter or a year, in this question it's a year, you have to do something very important. What you need to do is that you need to sum the column of income statement. Let's sum this up together. -1, +5, -3, -2, -2, -3. So net, it's going to be -$6,000. So what you are going to do is that at the end of every period, you are going to record the net value under income statement column to a column called retained earnings. Basically, what is retained earnings? These are the amount of net earnings firm makes during a certain period of time, but they do not distribute to their own shareholders yet. In year 2016, this supermarket made a loss of $6,000. And this loss is not distributable anyway to shareholders. But if you were making a gain, but you do not distribute this to your own shareholders, it is going to be transferred to unretained earnings. So how are we going to transfer this loss to retained earnings? Well, I'm going to put a positive $6,000 in the column of income statement so that if you sum it up, the income statement column will be net zero. And notice that this loss of $6,000 will show up under retained earnings. So now you are fully done and you're ready to prepare ending balances by summing individual columns. For example, if you sum the cash column, you are going to find that at the end of year 2016, the amount of cash in your bank account is $28,000. Similarly, in your shop, you have some inventories who originally costed you $2,000, so on and so forth. So basically what we have done is that for year 2016, we fully recorded all of the individual financial transactions. We started with initial balances of zero. We have a bunch of transactions, and we come up with some ending balances. So what's the next step? Since you are fully done with recording of individual financial transactions, now you are ready to prepare balance sheet and income statements. To prepare the balance sheet, what we are going to use is the row called ending balances. The numbers that you see for the ending balances will constitute the numbers that you see on the balance sheet. For example, at the end of year 2016, on balance sheet, for cash, you should see an amount of $28,000. For inventories, you should see an amount of $2,000, so on and so forth. If you want to write it a little bit more systematically, this is the balance sheet for year 2016 for the supermarket. Just like what we have said before, look at the amount of cash, $28,000. Amount of inventories, $2,000. And then we also have some fixed assets in the form of PP&E, which makes your total asset as $40,000. Similarly, we have accounts payable, bank loan, common stock, and retained earnings, whose summation will also give you $40,000. So good luck. You now prepared for your first individual balance sheet for this firm. How about income statement? If you want to prepare income statement, you are going to focus on the column called income statements. And then basically what is happening in this column, we have some insurance expense, we have some sales, we have some cost of sales, we have utility expense, employee expense, and interest expense. In order to prepare income statement, you are going to arrange this number a little bit. First of all, you are going to start with the sales of $5,000, which is exactly coming from the previous slide. We have cost of goods sold. This is the amount of inventories, the cost of the inventories that you're selling. It is $3,000, which is going to give you an important accounting number, gross profit. Gross profit is always defined as sales minus cost of goods sold. And then you need to worry about operating expenses. Operating expenses are expenses that you incur throughout your normal operations. So what are our operating expenses? These are insurance expense, utility expense, and employees expense. If you sum them up, it is going to be in total $5,000 of expense. So gross profit of $2,000, operating expenses of $5,000 will give you profit before interest expense of $3,000. And how much is our interest expense? According to this transaction worksheet, it is another $3,000, which is going to make your net income as $6,000 loss. And congratulations, you prepared your first income statement. In the previous video, we went through individual financial transactions of Illinois supermarket for year 2016, and then we prepared its first year of balance sheet and income statement. We are going to do now a similar exercise for the second year, for the year 2017, with a little bit more complicated individual financial transactions. So let's begin. What do we have in year 2017? We again have some purchase of groceries, payment of annual insurance premium, sale of groceries, pay creditors, pay utilities, pay employees, pay annual interest on bank loan, declare but do not pay dividends of $2,000, and finally, we need to worry about the amount of corporate tax. And corporate tax rate for this firm is 50%. So how are we going to go about this? First of all, we need to go back to our original transaction worksheet. We have to ensure that assets are always equal to liabilities plus shareholders' equity. Under assets, here are the accounts that I'm going to use. Notice that I did some abbreviations here. Under assets, I have cash. I have IMV, which stands for inventories. I have AR, which stands for account receivable. Just as a note, what is account receivable? We are going to make a sale, but we do not collect the money. It's going to be recorded as account receivable. On the other hand, we purchase some groceries to sell, but we do not pay the money. That's going to be recorded as accounts payable. What else do I have under asset side? We have PP&E, plant, property, and equipment. On the liability sides, I have DP, stands for dividends payable. This is the amount of dividends that we are supposed to pay our shareholders, but we didn't pay yet. We have TP, this is tax payable. This is the amount of tax I need to pay to governmental authorities, but I didn't pay yet. I have AP, this is our classic accounts payable. We have a bank loan. And finally, under shareholders equity side, I have common stock. This is the amount of investment of individual shareholders. I have IS, which stands for income statement, where I'm going to record revenues and expenses. And finally, I have retained earnings, RE. This is the amount of earnings we earn for our shareholders, but we do not distribute yet. So how are we going to start? First of all, you need to worry about the beginning balances. Notice that we are in year 2017. The firm is established in year 2016. Therefore, at the beginning of year 2017, you have some beginning balances. Where are these beginning balances coming from? These beginning balances are coming from this balance sheet. So basically, at the end of year 2016, you have the balance sheet for Illinois Supermarket, and these numbers on the balance sheet will constitute, at the beginning of the year 2017, numbers in your transaction worksheet. For example, let's ensure that at the beginning of the year 2017, the amount of cash is $28,000 and the amount of inventory is $2,000. Is this correct? Let's go to our question. That is indeed correct. After you write down individual beginning balances, now you're ready to go to the individual financial transactions for year 2017. So let's get started. What's the first one? We are going to get some inventories worth $10,000, but we are not going to pay for them. Therefore, they are going to be recorded as an increase in accounts payable. Second, we are going to pay insurance premium of $1,000. There is a cash reduction of $1,000, and then income statement will be recorded as insurance expense $1,000. Notice that these are in parentheses, so it is a decrease. It's a negative number. What's the next one? We are going to make a sale of $25,000, and these goods that we are selling in this transaction originally cost us $7,000. So how are we going to record this? Let's first worry about sales. Notice that income statement goes up by $25,000. But do we get money, cash, for the sale? The answer is no. Customers are not paying yet. Therefore, it's going to be recorded as accounts receivable. This is the amount of collections we expect from our customers. Second, these groceries costed us $7,000 originally. Therefore, there will be a reduction of $7,000 from inventories, and there will be a reduction in income statement of $7,000 as cost of sales. What is next? We are going to pay our creditors $8,000. Notice that cash goes down by $8,000. At the same time, accounts payable also goes down by $8,000. Our liabilities to our creditors are recorded under accounts payable. Therefore, if we make a payment to them, accounts payable should go down. Next, we are going to pay some utilities of $3,000. This should be easy by now. Cash goes down. It's going to be recorded as income statement reduction. Next, we are going to pay our employees $5,000. Cash goes down. It's going to be recorded as a reduction in income statement, and this is actually recorded as wage expense. Next, we need to worry about our annual interest expense for our loan. Let's remember our loan. This is $30,000 loan. Annual interest rate is 10%, meaning that every year the amount of interest expense is 30,000 times 10%, which gives you 30,000 interest expense. And the next one is a little bit interesting. We are going to declare but do not pay dividends of $2,000. So how do we record this? First of all, we are declaring but do not paying dividends. Therefore, there will be a dividend payable of $2,000. This is a liability. We are promising our own shareholders that we are going to give them $2,000. What is the second leg of this transaction? Well, dividend payments are recorded as a reduction from retained earnings. What was the retained earnings? Let's remember one more time. This is the amount of earnings earned by the firm for shareholders but not distributed yet. If, as a firm, you distribute these earnings to your shareholders in the form of dividends, it is natural that retained earnings will go down. So how do we record this transaction? Dividend payable will be recorded as $2,000 positive, and there will be a reduction in retained earnings of $2,000. So one more time, dividends are paid out of retained earnings. What's the next one? We need to now calculate the amount of tax. We know that our corporate tax rate is 50%. To calculate this, at this point, we need to stop and we need to calculate our total income up to this point. For this purpose, we need to go through income statement accounts one more time. There is -1, plus 25, -7, -3, -5, -3. If you sum them up, you are going to find a net income before tax of 6,000. We know that our corporate tax rate is 50%. Basically, 50% times 6,000 will give you 3,000 tax expense. So how are we going to record the tax expense? First of all, notice the income statement. There is a -3,000 recorded as a tax expense. But are we paying this tax yet? Not really. We are just recognizing it. Therefore, it's going to be recognized as tax payable. This is the amount of tax I'm going to pay to governmental authorities sometimes in the future. So now we are finished with recording our financial transactions. What was the last step we were doing before we calculate ending balances? You have to transfer the net number on income statement to retained earnings. If you sum income statement column, you're going to find that it is 3,000 positive. To transfer this 3,000 positive to retained earnings, you put a negative number of 3,000 on the income statement column, and then you notice that I record a 3,000 under retained earnings column. This is how I'm transferring the net balance on the income statement to the retained earning. And finally, you are now ready to come up with ending balances for each of these individual accounts. For example, at the end of year 2017, the amount of cash in your bank account is $8,000. The amount of inventory in your shop is $5,000, so on and so forth. This completes recording of total financial transactions for year 2017. Since you are done with recording financial transactions, now you are ready to prepare balance sheet as well as income statement for year 2017. How we were preparing balance sheet? We remember that these ending balances that you see here will constitute the balance sheet accounts figures for year 2017. For example, on the balance sheet of year 2017, the amount of account receivable needs to be 25,000. The amount of PP&E needs to be 10,000, so on and so forth. Is this true? And here is the balance sheet. Let's check. What is the amount of account receivable? $25,000. What's the amount of fixed assets? $10,000. So what is the total amount of total assets? $48,000. And similarly, your total liabilities plus shareholders' equity will also give you $48,000. So you prepare for year 2017 balance sheet for Illinois supermarket. What's the next step? Preparation of income statement. And how are we going to do that? We are going to do this by focusing on income statement column. Here, what do we have? Insurance expense, sale, cost of sales, utility expense, employee expense, interest expense, and tax expense. If you just arrange numbers a little bit, what is the amount of, for example, sales? $25,000. What is the amount of cost of sales? $7,000. And this is how they show up on the 2007 income statement. Say sales of $25,000, cost of sales of $7,000, which gives you a gross profit of $18,000. What was the next step in preparation of income statement? You need to worry about your operating expenses. Operating expenses are insurance expense of $1,000, utility expense of $3,000, employee expense of $5,000. And if you sum them up, operating expenses for year 2017 is $9,000, which gives you profit before interest and tax of $9,000. What is the amount of interest expense? $3,000. Therefore, your profit before tax is $6,000. What is the tax rate? 50%. 50% times $6,000 will give you a tax expense of $3,000. And finally, at the end of year 2017, you end up with $3,000 profits. And this completes preparation of income statement for year 2017. Now, it's a very good time to go through something very important about individual accounts. How do individual accounts change? All individual accounts change according to the following schedule. There is a beginning balance. Individual accounts goes up within a year or a quarter. Then they go down because of some reductions. And then at the end of every year or quarter, you calculate ending balances. So how can we use this framework? So here is an example that we went through for Illinois supermarket in year 2017. Let's precise the focus on accounts payable account. And my question here is, what is the cash paid to suppliers in year 2017 for this supermarket? So to answer this question, let's remember the framework on how individual accounts change. Beginning balance. The balance of accounts payable will go up by some new purchases of inventories. And then this amount will go down by payments to suppliers, which is what's asked in the question. And at the end, we should be able to calculate ending balances. So what's the beginning balance of accounts payable in year 2017? If you go back to our original question, it is 1,000. In year 2017, we purchased new inventories of 10,000, which constitutes additions during the period. What we are asked is the payments to suppliers. In other words, we are asked the reductions from accounts payable in year 2017. We don't know. But let's say we are given the amount of ending balance in accounts payable, 3,000. So you now know the beginning balance, you know the additions, you do not know reductions, and you know the ending balances. And after some algebra, you can calculate that the payments of suppliers or reductions in year 2017 for accounts payable is $8,000. This is a very, very important tool that we are going to use over and over again in this course. Therefore, it's a very good idea to go through some of these accounts, some of these transactions by yourself. For example, do this for account receivable and whether you can calculate reductions in account receivable in year 2017 by yourself. Now it's the perfect time to go through probably the most important concept in current accounting practice, that is accrual accounting. To understand accrual accounting, what I'm going to do is that I'm going to remind you two individual financial transactions we went through for Illinois supermarket in year 2. These were payment of insurance premium of $1,000 and payment of employee salaries of $5,000. So let me change these questions a little bit. Suppose that half of the insurance payment, which is $500, is prepayment for next year's insurance. Suppose also that employees earn $5,000, but they are not paid yet. My question is, what happens? So let's remember the original solution. For year 2002, there was an insurance payment of $1,000. Cash goes down, and then it's going to record as insurance expense in income statement. Similarly, if you pay employees $5,000, there's a cash reduction of $5,000, and then it's also recorded as a wage expense on income statement. So how do we go through our updated questions? The first one was that there is an insurance payment of $1,000, but half of this insurance payment is a prepayment for next year's insurance. How do we record this? First of all, there is a reduction of $1,000 in cash because we paid this. Out of this $1,000, half of this is related to year 2017's insurance expense. Therefore, it is recorded as reduction from income statement. And the next remaining $500, which is the prepayment for next year insurance, will be recorded as prepaid expenses. In accounting, when we prepare, for example, some rents, some insurance, we record this as a prepaid expenses. Notice it's a prepaid expense account, but it is recorded as an asset. This is a resource that we are going to use next year. How about the next one? Our employees earn but are not paid $5,000 yet. Since they earn it, I'm going to record this $5,000 as a wage expense on income statement. On the other hand, I'm not paying them yet, but I am going to pay in the future. Therefore, this $5,000 will be recorded as accounts payable. In general, accounts like prepaid expenses, accounts payable, account receivable are called accruals. What is accruals or accrual accounting? Under accrual accounting, we are going to use adjusting entries to ensure that the accounting reflects economic reality of the firm. So what do I mean? For example, look at the employees. Our employees work for us. They earn $5,000, but I'm not paying them yet. Although I'm not paying them yet, I'm still recording this in our transaction worksheet. Whether you pay or not doesn't matter here. As long as they earn this money, it's going to be recorded as a wage expense. In general then, under accrual accounting, we are going to record revenues whenever they are earned, no matter whether you collect the money or not. Similarly, under accrual accounting, we are going to record expenses when they are incurred, and regardless of whether you are getting the money or paying money. It doesn't matter. Therefore, under accrual accounting, you are going to notice that profits are not necessarily equal to changes in cash. For example, for our question in year 2017, the net change in year 2017 is minus $20,000. On the other hand, if you look at the income statement, the amount of net income is $3,000. They are not related to each other. So what's the summary? Cash accounting is very simple. You record a financial transaction only when it involves cash, but it has nothing to do with economic reality. You can make lots of sales, for example. If you don't collect cash under cash accounting, it's not going to show up on your revenues. Accrual accounting will reflect business reality. We are going to record revenues whenever they are earned. We are going to record expenses whenever they are incurred. But there is a big problem with accrual accounting. What is this big problem? Accruals require a lot of judgment, and we are going to see a lot of examples on how we are going to making judgments in accrual accounting. And sometimes managers make judgments to inflate earnings that they report to outsiders. So here is a summary of what we have done in this class. First, we went through how we are going to code individual financial transactions. In other words, we worried about how we can write individual financial transactions in accounting language. And then we went through how we can prepare in the balance sheet and income statement, and then we evaluated accrual accounting and cash accounting. Our current practice is we are using accrual accounting, but we need to be very worried about something, which is usage of managerial discretion. In the next class, I'm going to go through fundamental accounting concepts, and I will also go through revenue recognition principles. If you are aware of financial scandals, accounting scandals over the last 10 years, you are going to notice that most of them are because of revenue recognition. It's going to be an interesting class, so stay tuned. Hello, now it's a good time to go through some cases to apply what we have learned in module number 2. Just like before, I strongly recommend you first download the case questions, work on by yourself, and then come back and watch the solutions so that you get the maximum benefit out of these cases. Here is case number 1. Smith & Jones Sporting Goods started operations on October 1st, 2015, and at 30th September 2017, which is basically 2 years later, had the following summary of balance sheet. So if you look at the asset side, we start with fixed assets. So this is like a British style of balance sheet. And then we have some liabilities and shareholders' equity. And then during the year ended September 30, 2018, which is basically the third year of operation, which is basically next year, the company engages in the following transactions. 1, payment of $8,300 of accounts payable to suppliers. 2, collection of $4,500 of account receivable from customers. 3, sale of sporting goods, merchandise originally costing $5,300 for $8,950, of which 30% is on credit, the remaining is, which is 70% in cash. 4, payment of $3,500 for employee wages in cash. 5, purchase of sporting goods, merchandise from suppliers on credit for $1,900. 6, issue of 500 shares of common stock in exchange of $2,000 in cash. 7, on June 30, 2018, the company prepays an annual insurance premium of $1,200. This policy covers July and June 2019. Just to make sure that we are on the same page, this is an annual insurance premium. There are 12 months. The amount is $1,200. So basically, insurance premium per month is $100. And finally, on October 31st, 2018, the company will pay a dividend of $350. Our job here is to record these transactions in a worksheet and prepare balance sheet and income statement using the templates on the following pages. And here is the template, which is, I feel, these numbers. So how do we start? First, we start with the beginning numbers that are given in the beginning balance sheet. For example, fixed assets was $17,000, so on and so forth. So what's the first transaction here? Payment of $8,300 of accounts payable to suppliers. So this is a payment. Therefore, there will be definitely cash reduction. And then since you are paying the suppliers, accounts payable will also go down. The second transaction here is collection of 4,500 of account receivable from customers. Since you collect money, cash will go up by 4,500, and then you're collecting from your customers, therefore account receivable will go down by 4,500. Third, sale of sporting goods merchandise originally costing 5,300 for 8,950, of which 30% is credit and the remaining 70% is in cash. Whenever there is a sale, there are actually two transactions. One, you need to record the sale. Two, you need to record cost of goods sold. So let's start with recording sales. So 8,950 is included in the income statement, all right, that's the revenue, out of which 30% is on credit. Therefore, account receivable will go up by 30% of 8,950, and the remaining amount, 6,265, will be increased in cash. And the second component of any sales is cost of goods sold recording. You are selling this out of your inventories, therefore inventory will go down by 5,300, and then 5,300 will also be recorded under income statement as a cost of goods sold. Next, payment of 3,500 for employee wages in cash. So what's going to happen? First of all, there will be cash reduction of 3,500, and 3,500 will also be recorded as an expense on income statement for wage expenses. The next item here is purchase of sporting goods merchandise from suppliers on credit for 1,900s. So if we buy this, first of all, there will be an increase in inventory of 1,900. Do we pay for this? No, because the question says it is on credit. Therefore, 1,900 will also be used to increase accounts payable. The sixth item here is issue of 500 shares of common stock in exchange of $2,000 in cash. Well, cash will go up by $2,000, and $2,000 will also be recorded under common stock. The next two items are a little bit tricky. Before we go further them, let's just ensure that we are on the same page. Our firm fiscal year end is September 30, 2018, which is the third year of operations. So what is the seventh transaction? On June 30, 2018, the company prepays an annual insurance premium of $1,200. This policy covers July 1st, 2018 to June 30, 2019. All right, so what are we going to do? First, we are going to pay for this insurance. Therefore, there will be a cash reduction of $1,200 from cash. Then it is going to be recorded as a prepaid insurance. But notice that some of this insurance will be used in the fiscal year ending September 2018. So when does this policy covers? July 2018 to June 2019. So basically July 2018, August 2018, and September 2018 insurance has already been used. Therefore, if you look at the income statement column, there will be 300, which is insurance expense for July, August, and September. And the remaining amount, which is 900, will be recorded as a prepaid insurance. Let's just recap this. We buy an insurance, we prepare it. Out of this prepayment, we use for this insurance for the first 3 months, because our fiscal year end is September 2018, and the remaining will be recorded as prepaid insurance of 900. And next tricky part is October 31st, 2018, the company will pay a dividend of 350. So our fiscal year end is September 2018. So it's next month we are going to pay a dividend of 350. Therefore, you are going to record a dividend payable of 350 under payables, and then 350 will be recorded as a reduction from retained earnings. Let's just remember one more time. Dividend payments are always a reduction from retained earnings. And finally, we are going to transfer the balance from income statement to retained earnings. If you sum all the numbers on the income statement, you are going to see that we actually make a loss of $150. To transfer this loss, you put a positive 150 under income statement, and you put negative 150 under retained earnings, and finally you come up with the ending balances that you see on your screen. After this, it is easier to come up with the balance sheet and income statement for the year ended September 2018. Here is the balance sheet, asset side. At the end of year 2018, Our total amount of asset is 49,541, and here's the liability side of the balance sheet. And we got all of these numbers on the balance sheet from, if you just go back, from the last line of this transaction worksheet. Whatever you see on the last line is summarized on a balance sheet. Let's also look at the income statement. As you see, if you sum all the sales, cost of goods sold, and all the operating expenses, you make a loss of $150 during the year ended September 2018. Here is question number 2. In each of the following questions, you have transactions that were either missed or made an error in the annual financial statements ending on December 31st. Let's just keep this in mind. Our fiscal year is ending December 31st. Indicate the amounts involved and the effects on each of the accounts listed using the following notation. O stands for overstated, U stands for understated, no effect, and E. Each transaction is independent. For each question, make sure that you show by what amounts the financial statements are wrong before the corrections are made for the forgotten or mistaken transactions. Of course, ignore any effects of taxes. Here is question number 1. Sparrow Nightingale is a retailer that sells rare books on DVDs. On September 25, 2016, Sparrow and Nightingale prepays the next 12 months insurance policy on their shop for $18,000 in cash. Sparrow and Nightingale's accounting didn't record the entry for prepayment of insurance policy, nor did it make any other entries during the year for the insurance policy. So what is the impact of these forgotten entries on the following items? We have current assets, current liabilities, long-term assets, long-term liabilities, capital stock, retained earnings, and net income. The best way to approach such a question is actually to record these mistaken or forgotten transactions by yourself and then compare them to the current status of the balance sheet and income statement. So let's just do it. What's happening? On September 25, we are going to prepare for this insurance. And what is the amount of this prepayment? $18,000. So if you look at the current asset columns, there is minus $18,000, which is cash, right? You pay $18,000. There is also plus $18,000, which is for prepaid insurance. So because of the September 25 transaction, basically net, there is no change, all right? So cash goes down, prepaid insurance goes up. Now we come to the end of the year, December 31st, 2016. Do we need to do anything? Yes, we need to definitely do an adjustment for insurance that we have already used. What is the amount of this insurance we have used? Well, first of all, $18,000 is for a year. Divided by 12 is going to give you how much? $1,500. So for every month, your insurance premium is $1,500. And when is this insurance premium is effective? Well, it's effective October, November, and December of this year. Therefore, you use this insurance for 3 months. Therefore, there should be an insurance expense of $4,500. That's the reason why on the income statement, in the second row on the income statement column, we have $4,500 as an expense, and then $4,500 is also reduced from the current assets from prepaid insurance column. And then what do we do at the end of the year? We close income statement to the retained earnings. So whatever we have on the income statement is transfer the retained earnings, and here are the final balances. So and if you look at the last line, what's happening? Because we forgot to record these transactions, all right? Normally, our current assets should be minus $4,500. We recorded, so at the moment, our current assets is like 0. Therefore, your current assets are overstated by $4,500. Similarly, your retained earnings is overstated by $4,500. And finally, your net income is also overstated by $4,500. You forgot to record this insurance expense. It doesn't show up in your income statement. Therefore, your net income is also overstated by $4,500. From time to time, I get questions on, look, professor, we closed the net income. Therefore, there should be no impact on the net income. So some people get confused about this. There is no need to confuse. So we are using the transaction worksheet to make our job easy. When you look at any income statement, you will never ever see 0, right? So all you need to think about is that whatever happens on the income statement is automatically reflected on retained earnings. Okay, that's the way you approach this. Therefore, income statement is never zero in reality. So we are using this notation of, look, at the end of the year, just to close the income statement, retained earnings. Another way, or more proper way to think about is that whatever happens on the income statement is automatically reflected on retained earnings. Therefore, we have an overstatement both in retained earnings and net income. Here is the second question. On April 13, 2018, Yahoo Inc. company sold inventory which originally costed $13,560 to customers for $21,000 on account, not cash. Yahoo Inc. company didn't record either of these entries related to this sale. All right, what was the best way to approach this question? You are gonna record them. First, we are gonna record the sale of $21,000, right? And how did we make this sale? It is on account. So basically, under current assets, account receivable will go up by $21,000, and then you are going to record $21,000 on the income statement. And whenever there is a sale, there is a cost of sale. So what's the cost of goods associated with this sale? It is going to be $13,560, which is going to be reduced from inventory. Therefore, there is a reduction of $13,560 from current assets. And $13,560 is also reduced from income statement as cost of goods sold. Year end comes, whatever the balance we have on the income statement is transferred to retained earnings, which is going to be a profit of $7,440. So we forgot to record all of these numbers. So therefore, what happened? Our current assets are understated by $7,440. Our retained earnings is also understated by $7,440. And our net income is also understated by $7,440. There is no impact on other items on your screen. And here is the third question. On May 13, the Gathering Sound purchased merchandise worth $13,000 from suppliers on account. On May 28, the Gathering Sound pays $9,370 in cash to these suppliers. Suppose the accounting at the Gathering Sound Limited forgot to record both of these entries. All right, let's record them. First of all, we are going to make a purchase of inventory on account. Therefore, current assets will go up by $13,000. It's under inventories. And then current liabilities, which is accounts payable, will also go up by $13,000 because we are not paying for this. Next, we are going to pay $9,370 for these inventories. Cash will be reduced by $9,370, which is going to be under current assets. And $9,370 will also be reduced from current liabilities because we are paying this accounts payable. And at the end, what happens? Your current assets should be $3,630 and current liabilities should be $3,630, which we forgot. Okay, we forgot all of these numbers. Therefore, your current assets are understated by $3,630 and your current liabilities are also understated by $3,630. And there is no impact in other items on your screen. And here is our third case, which is about accrual accounting. Moving On Limited starts operations on March 1st, 2015, and in each of these first 2 years, prepays 1 year's rent on the building it uses for operations. The end of Moving On Limited Limited's accounting period is December 31st. And here we have the prepayments for year 2015 and 16. In year 2015, this company prepays $24,000, and in year 2016, this company prepays $25,200. Making whatever assumptions you consider reasonable and using the template below, prepare the relevant extracts from the transaction worksheets for year 2015 and 16. So here is transaction worksheet for year 2015. All right, first in March, we are going to make a prepayment of $24,000. Therefore, cash goes down by $24,000, prepaid rent goes up by $24,000. Remember, this is a prepayment for a year. 24,000 divided by 12 is going to give you rent payment of $2,000 per month. So we are coming to the end of the year. Between March and December, you are going to use this building. Therefore, you are going to reduce some of these prepayments. So between March and December, how many months are there? 10. For every month, the amount of rent is 2,000. Therefore, the amount of prepayments that you use is 2,000 times 10. It's going to be 20,000. Therefore, prepaid rent goes down by 20,000. Income statement records a 20,000 rent expense. IS stands for income statement. And the year end comes. Whatever we have on the income statement is transferred to retained earnings. And here are the final balances for year 2015. Notice that we still have 4,000 prepayment of rent from year 2015. So we are going to repeat this for year 2016 too. The transactions will be similar. So we are going to start with opening balances of 2016, which are the ending balances of year 2015. Notice that 4,000 still is there. First, between January and February, we are going to use this prepayment of rent. Therefore, there is 4,000 reduction from prepaid rent, and then 4,000 is recorded as an rent expense on the income statement. In March 2016, we are going to make another prepayment for rent, which is covering the next fiscal year. So what is the amount of this next prepayment, this second prepayment? 25,200. Cash goes down by 25,200, and the same amount is recorded under prepaid rent. Between March and December 2016, you are going to use this building. So you have 10 months of usage. So prepayment amount was 25,200 for 12 months. If you divide this by 12, you're going to see that for every month, the amount of rent is 2,100. If you use this building in year 2016 for 10 months, the amount of prepayment you use is 2,100 times 10. It's going to be 21,000, which is going to be reduced from prepaid rent. It is going to be also recorded as a rent expense on income statement. Now we come to the end of the year. Whatever we have on the income statement, which is a 25,000 rent expense, is transferred to retained earnings. And here are the closing balances. Here is case number 4. This looks like your case number 1. It's a good idea to go through this again so that you learn much better. So Waltzing Alone is a retailer, sells running apparel and footwear, began operations on April 1st, 2015, and at 31st March 2016 had the following summary balance sheets. So here is the assets, liabilities, and shareholders' equity item at the end of March 2016. During the year ended March 2017, basically the second year of operations, the company engages in the following transactions. 1. Purchase of merchandise inventory worth a total of 33,800 from suppliers. 70% of this inventory was purchased on credit. The remaining 25% was paid in cash. 2. Cash payment of 17,330 of accounts payable. 3. Payment of interest on note payable of 1,750. 4. Sale of merchandise inventory originally costing 17,245 for 38,170. Customers paid 50% in cash. The remaining 50% was purchased by customers on credit. 5. Payment of 15,300 in wages to workers in cash for work completing during the year. And then during the year ended March 2017, we have 2 more transactions. Collection of 8,050 in cash of accounts receivable and payment of 450 in cash for utilities during the year. And then we have a couple of special items. On April 2017, the company will pay an additional $500 in wages to workers for work completed during March 2017. 9. Tax at a rate of 28% is payable on the company's profit before tax and is due June 30, 2017. Our job is similar. We are going to record these transactions and then we are going to come up with income statement and balance sheet according to prepared worksheet entries. So here is the transaction worksheet to record these transactions. We start our journey by first putting down our initial balances, which is coming from the balance sheet that has been introduced at the beginning of this question. For example, under opening balances, the amount of cash is 52,918. So what is our first transaction to record? Purchase of merchandise inventory worth a total of 33,800 from suppliers. 75% is on credit, the remaining 25% is paid. So what's going to happen? There will be an inventory increase of 33,800, out of which 75% will be on credit. Therefore, accounts payable will go up by 25,350. And then cash is 25% is paid. Cash reduction will be 8,450. The second transaction is cash payment of 17,330 for accounts payable. Okay. Since you are paying this, there will be a cash reduction of 17,330, and accounts payable will also go down by 17,330. The third transaction is payment of interest on notes payable of how much? 1,750. Cash goes down by 1,750, and 1,750 is also recorded on the income statement as an interest expense. Item number 4, sale of merchandise inventory originally costing 17,245 for how much? 38,170. Customers pay 50% in cash, 50% in credit. Whenever we have a sale, we have two lines. First, we are going to sell this merchandise. What is the amount of revenue? 38,170. Half of this is paid, therefore there is a cash increase of 19,085. Half of them is in credit, therefore account receivable will go up by 19,085. Whenever there is a sale, there is also a cost of sale. What is the cost of goods sold? 17,245. This is going to be reduced from inventories, and it's also be recorded under income statement as a cost of goods sold. Next, payment of 15,300 in wages to workers for in cash for work completed during the year. So let's just pay the wages. There will be a cash reduction of 15,300, and 15,300 will also be recorded as a wage expense under income statement. The next item here is collections of 8,050 in cash of account receivable. Since you are collecting this money, cash goes up by 8,050, and account receivable will go down by 8,050. Next, we have a payment of 450 in cash for the utilities during the year. Therefore, cash goes down by 450. 450 is also recorded as an income statement expense for utilities expense. And we have also two transactions that we got to be careful. Before we go further, let's just remind ourselves that this is a firm for which fiscal year end is March 31st. So what is item number 8 here? On April 2017, which is basically the next month, the company will pay an additional $500 in wages for workers for work completed in March. So workers work for us in March. We owe them a $500, which is going to be paid next month. Therefore, what's going to be happening? There will be under liabilities, there is a wage payable of $500, and $500 will also be recorded on the income statement as an expense. Why? Because this is for workers who already worked in March, which is included in fiscal year. And the second thing that we got to be careful is the tax, 28%, which is going to be payable June 2017. So if you do the calculations, you're going to see that 28% of all the profits and losses so far is 819. It is going to be recorded as a tax payable under liabilities, and it's going to also be recorded as a 819 income statement tax expense. The year end comes, whatever balance we have on the income statement is transferred to retained earnings. It looks like that after all of these transactions, the amount of revenue, expenses, everything, the net income is 2,160, which is transferred to retained earnings. And finally, we close our balances. So if you look at the last line, it says CB. CB stands for closing balances. After this, our life is relatively simple. We can prepare the balance sheet. If you look at the balance sheet in year 2017, the assets goes up to 99,395, and the liabilities, there is not much change except some accounts payable in the liabilities, and also there is not much change in the shareholders' equity. And then on the next line, we can see the income statement. As we have just briefly discussed, the amount of net income after all the revenues and expenses for year 2017 is 2,106. Here is question 5. This is just like question number 2. We have some transactions for which we missed, we forgot, we made mistakes. Our job is to correct them and identify their effects on different financial statement items. Just to remind you briefly, the fiscal year end is December, and then we need to use the notation of whether something is overstated, understated, or there is no effect. Here is first question. It's a long one. Let's just read briefly. Goats Guitar Works pays wages of $8,400 to its workers every 2 weeks. $8,400 for every 10 days, or $840 per workday. Workers are paid $8,400 on Friday, December 27, 2015, for the pay period December 13 to December 27. They will be next paid $8,400 on Friday, January 10, 2016, for the two-week pay period ending on January 10. The question tells us that for this pay period, assume that there are 2 workdays left in December, 8 workdays in January. The accountant for Goats Guitar Works didn't record any entry for the wage payment on December 27, nor did they make any entries on December 31st for 2 remaining working days' wages. So our job is to identify the impact of all of these forgotten entries on these items: current assets, current liabilities, long-term assets, long-term liabilities, capital stock, retained earnings, and net income. So what was the best way to tackle this question? We record these transactions by ourselves. First, on December 27, 2015, we paid these workers $8,400, which we forgot to record. If you pay it, there will be a cash reduction, which is the current assets, $8,400. And there should be a wage expense on the income statement of $8,400. Second, we also forgot to record that these guys worked for us 2 more days. We didn't pay them, but we should do something about this. For 2 days, how much do we owe them? It is $840 per day. Therefore, for 2 days, it is $1,680. You need to create a wage payable under current liabilities of $1,860. You need to also record as a wage expense on income statement as $1,680. And finally, whatever the balance that you see on the income statement is transferred to retained earnings. It is going to be $10,080. And here are the final balances, ending balances for the year. Current assets should be minus $8,400. Current liabilities should be $1,680. And retained earnings should be minus $10,080 minus. So therefore, what is the impact of all of these transactions on these items? Your current assets are overstated by $8,400. Your current liabilities are understated by $1,680. Your retained earnings is overstated by $10,080. And your net income is also overstated by $10,080. Again, let's not confuse ourselves. You are going to see this transaction both in net income and retained earnings. We are not closing the net income. We are just transferring whatever on the net income to retained earnings. We are reflecting, we are mirroring. Whatever happens on net income is reflected on retained earnings. Here is the second example where we are forgetting some transactions. Shiza Star Corporation issues 1,000 shares of common stock in exchange of 15,000 in cash on December 11, 2011, and purchase equipment worth 4,000. Neither entry was recorded. Let's just record them. First of all, we are going to issue stock. It is for 15,000. Cash goes up under current assets, and 15,000 also is recorded under capital stock. Second, we are going to purchase equipment. Therefore, and we pay for this in cash. Therefore, current assets goes down by 4,000, and long-term assets goes up by 4,000 because this is like a PP&E, long-term equipment. And finally, here are the ending balances. So our ending balances, current assets should be 11,000, long-term assets should be 4,000, and capital stock should be 15,000, which we forgot. Therefore, our current assets are understated by 11,000, long-term assets are understated by 4,000, and capital stock is understated by 15,000. And here is the third small question under case number 5. Space Incorporated receives a bill for $925 for December's utilities on December 31st, 2018. This utility bill will be paid on next year, January 9, 2019. This firm's accountant didn't record any entries related to this utility bill. So let's just record them. If you get a utility bill, what's going to happen, and you're not going to pay yet, you're going to create a utility payable under current liabilities of 925, and then you're going to record this 925 on income statement as an expense. At the end of the year, whatever you see on the income statement is transferred retained earnings, 925, and here are the ending balances. So therefore, your current liability is understated by 925. Your retained earnings is overstated by 925. Your net income is also overstated by 925. And here is our last case in this module. This looks like your case number 3. Again, we are going to talk about some accrual accounting. Say Something Incorporated starts trading on January 1st, 2015. On June 1st, 2015, it takes out a 6-year bank loan of how much? $42,000 at 5% annual interest rate. Okay, it's 6-year, $42,000, 5% annual interest rate. Interest payments are made semi-annually on May 31st and November 30th. Making whatever assumptions you consider reasonable and using the template below, prepare the relevant extracts from the transaction worksheets for 2015 and 16. All right, here is 2015. First, let's obtain this loan. Cash goes up by 42. Bank loan goes up by 42. Second, in November 2015, we are going to make the first payment of this interest. And what is the amount of this interest? $1,050. Where is this coming from? Well, annual interest rate is 5%. Therefore, semi-annual interest rate is 2.5%. So basically, $1,050 is coming from 2.5% times 42,000. How do we record this? Cash goes down by $1,050. $1,050 is also recorded as an income statement interest expense. And then for December, we need to record an accrual, which is what? Which is the interest expense for December. What is the size of this December interest expense? Well, for 6 months, the amount of interest expense is $1,050. Therefore, for 1 month, $1,050 divided by 6 is going to be $175. So $175 is recorded as an interest expense under income statement, and $175 is also recorded under liability as an interest payable. Next, we transfer whatever the balance we have on the income statement to the retained earnings, which is a total interest expense of $1,225, and here are the closing balances. Next, we do the transactions for year 2016. Last year's closing transactions become this year's opening balances, as you can see here. First, we are going to pay interest in May. The amount of payment, as we have seen in the previous slide, was $1,050. This May payment includes December of last year versus 5 of this year. Therefore, first you close the interest payable of last year, $175, and then $875 becomes this year's interest expense for January, February, March, April, and May, 5 months of interest expense. In November 2016, you make another semi-annual interest payment. So $1,050 is reduced from cash. $1,050 is also recorded on the income statement as an interest expense. And then you need another month of accrual for year 2016. It is for December 2016 interest expense. It's again $175. And $575 is also recorded as an interest payable under accruals. And then whatever the balance we have on the income statement is transferred to retained earnings. It's going to be $2,100 total interest expense for year 2016. And here are the final balances at the end of year 2016. This completes my cases for module number 2. I hope you find them useful. Thank you. Hello, welcome to Module 3 of Financial Accounting Foundations here at University of Illinois. Here is a brief overview of what we are going to do today. First, we are going to cover fundamental accounting concepts. Second, if you might remember last time, we made a small introduction to accrual accounting. Today, we are going to spend some more time on this and we will cover some more exercises. And finally, we will discuss in detail revenue recognition principles in accounting. Hello, now it's a good time to talk about fundamental accounting concepts. When firms are preparing their financial statements, they are guided by some certain principles in accounting. So what are they? The first one is going concern principle. Under going concern principle, we assume that the firm will be in the business for a long period of time. So why this is a big deal? Suppose that we have the financial statement information of a firm which is going to go to bankruptcy in next year. Then most of the numbers that you see on those financial statements are probably misleading. Why is that so? For example, if the firm is going to bankruptcy next year, the values of liabilities that you see on the balance sheet are generally understated. Why? Because when firm is going to bankruptcy, they need to pay for some other liabilities, such as redundancy costs. We also see some misstatements in the asset side too. If the firm is going into bankruptcy, they may not recover all of the values of the assets that they show on their balance sheet because they need to sell their assets quickly. They need to pay all of their liabilities. If you want to sell your assets quickly, then you will not be able to sell those assets with a price that you see on the balance sheet. So most of the time, if the firm is going to bankruptcy, the values of the assets that you show on the balance sheet are higher than what it should be. So therefore, we make the assumption that the firms will be in the business for a long period of time. Otherwise, you need to question the validity of the numbers on balance sheet and income statements. The second principle that we are guided by when we prepare financial statements is conservatism. Under conservatism, we will be very careful in booking revenues in income statement. We have to ensure the revenues are earned. On the other hand, when booking expenses, we will not be that careful. When booking expenses, even if there is some uncertainty these expenses might happen or not, we are going to go ahead and book these expenses. So under conservatism, you are very careful in booking revenues. You book the revenues only if they are earned, but for expenses, even if there is some uncertainty, you will go ahead and book them on income statements. We will spend some more time on conservatism soon. The third principle that we are guided by in preparing financial statements is matching principle. Under matching principle, the idea here is that whenever you book revenues, you need to book all the costs of that revenues. And we already have seen an example of this in the module number 2. If you might remember, there was a firm making a sale and it was booking revenue. But as soon as it books revenue, the firm was also booking the costs of this revenue in the form of cost of goods sold. And that's an application of matching principle. The fourth principle that we are guided by when we prepare financial statements is consistency. Consistency has two dimensions. First of all, within a firm, we are going to assume that firms are using the same set of accounting rules and regulations across different years. Therefore, if you have a financial accounting information for a firm for many different years, you can easily compare them. Similarly, under consistency principle, within a year, firms from many different industries use similar accounting rules or regulations so that their information can be compared within the year. And the last principle is a little bit familiar to you from the last time. It is accruals principle. Under accruals principle, we will book revenues whenever they are earned. We will book expenses whenever they are incurred. We are not going to wait until cash transaction happens. In other words, under accruals principle, our job is to reflect the economic performance of the firm regardless of cash collection or cash transaction happens. And we are going to spend some more time on accruals principle in the next video. In the last class, we made a small introduction to accruals concept. Under accruals concept, we book revenues whenever they are earned. We book expenses whenever they are incurred. So we are not very much worried about cash transaction. If we go a little bit more detail on accruals principle, because it's very important, accruals principle manifests itself in two different ways. The first one is accruals. Here we have cash collection after revenues are earned, or we have cash payments after expenses are incurred. So basically, first we have the economic transaction, and then cash transaction comes. So what are some examples of accruals? Here is one. We have a firm providing service and earns $500 in November 2016, which is payable in April 2017. So what was the principle about accruals? First, economic transaction will happen, and that's exactly what is happening here. The firm works and earns $500, and then the cash transaction will come. And the cash transaction will come next year in April. So how are we gonna go ahead and book this transaction? First, firm works and earns $500. Therefore, on the income statement, we book a revenue of $500. Since firm is not able to collect cash yet, this $500 is also recorded as an accounts receivable. It's going to be receivable sometime in next year. Okay? And the year end comes, and as you might remember, when the year end comes, we close income statement and we transfer the balance on the income statement to the retained earnings. So if you look at the income statement, we have a revenue of $500. To close this, we book a negative $500 on income statement, and then we also put positive $500 on the retained earnings. And this way, we transfer the balance on the income statement to retained earnings. And at the end of year 2016, here are the balances. We have account receivable of $500, and we also have retained earnings of $500. Next year comes, the firm receives $500 in April 2017. So how are we going to book this? First, this is not the first year that the firm is in business. Therefore, there are some opening balances, which is the same as closing balance of last year. Account receivable $500 and retained earnings $500. When the firm receives cash, cash balance will go up by $500 and account receivable will be reduced by $500. And now we are ready to close these financial transactions for year 2017. At the end of year 2017, we have a cash balance of $500. We also have a retained earnings of $500. Here's another example. Again, we are talking about accruals. There is first economic transaction, and then cash transaction will come. Here we have a firm receiving a utility bill of $250 in December 2016, which is payable in January 2017. So how are we going to book this? First, the firm receives utility bill. Since these utility bills are some form of expenses, we are going to book an expense on the income statement as $250. But firm is not supposed to pay this money yet. Therefore, we create a liability called utility payable, which is $250. The year end comes. Therefore, we need to transfer the balance on the income statement to retained earnings. So income statement balance before this transaction is $250 expense. To close this, you put a $250 gain, and then you book a $250 expense on retained earnings. So at the end of year 2016, then here are the closing balances. We have a utility payable of $250, and we have a retained earnings of $250 expense. Next year comes, and it's now time to pay this utility bill. The firm pays the utility bill of $250 in January 2017. We have an opening balances, which are same as the closing balance of last year. Utility payable of $250, retained earnings $250 expense. The firm pays this $250, therefore cash goes down by $250, and at the same time we get rid of utility payable because it's paid. And at the end of year 2017, here are the closing balances. Cash minus $250 and retained earnings minus $250. We said accruals concept manifests itself in two different ways. The first one was accruals. Under accruals, first economic transaction and then cash transaction. The second version of accruals concept application is deferrals. Under deferrals, first cash transaction comes and then economic transaction comes. So what are some examples? We have a firm receiving $1,000 in October 2016 as an advance payment for a job to be delivered in December 2016. As you notice here, first we have the cash transaction, firm receives $1,000. And then firm is going to go deliver the service in December 2016. How are we going to book this? Well, first of all, firm gets $1,000. Therefore, cash balance will go up. Can we book this as a revenue? Not yet, because the firm didn't earn this money yet. We have to be very conservative to book this as a revenue. Therefore, until this money is earned, we are going to book this as an unearned revenue, which is a liability account. Under unearned revenue, we will see the amount paid by customers, which is not earned by the firm yet. Now, December 2016 comes, firm provides the service. Now, firm earns this $1,000. So how are we going to book this? First, we will get rid of the unearned revenue balance. And secondly, we are going to book $1,000 under income statement. The year end comes, we need to close all these financial transactions, and we need to transfer the balance on the income statement, retained earnings. So as you can see, the balance on the income statement, $1,000, is transferred to retained earnings. And here are closing balances at the end of year 2016. We have cash of $1,000. We also have retained earnings of $1,000. Let me show you one last example about deferrals. Here we have a firm. It pays $1,500 in January 2016 as an advance payment for the next 2 years rent. So basically for each year, the amount of rent is $750, and the firm pays $1,500 at the beginning of year 1 for the next 2 years rent. How are we going to book this? Notice again that first we have cash transaction, cash is already paid, and then we will need to book some revenues and expenses. First of all, we pay $1,500 as an advance payment. Therefore, there will be a reduction of $1,500 from cash. How are we going to book this? Is this an expense? Not yet. This is just advance payment. We are paying advance payment of rent for the next 2 years. We didn't use this building or facility yet. Therefore, it's not going to be expense right now. It's going to be expense over the next 2 years. Therefore, initially, we are going to call these advance payments as prepaid rent. $1,500. Notice that this is an asset. These are here under prepaid rent or prepaid accounts. We book advance payments. So year 1 ends. At the end of year 1, we use this building or facility for 1 year. Therefore, you need to recognize 1 year's rent expense. How are you going to do that? First of all, you book $750 as a rent expense on the income statement. And secondly, you reduce $750 from prepaid rent account on the balance sheet. Year end comes, you need to transfer the balance on the income statement to retained earnings. How are we going to do that? To transfer the balance on the income statement is minus $750, and notice that we put the gain of $750 on the income statement, and we also book $750 on retained earnings. And here are the closing balances. At the end of the first year, we have cash reduction of $1,500. We still have 1 year of unused prepaid rent, $750, and then we have under retained earnings, $750 as an expense. Now, it's a good time to practice what we learned. Your job is to look at the balance sheet of Walmart and to identify accruals and deferrals. So in particular, you are going to go through assets of the Walmart and liabilities of the Walmart and to find all deferrals as well as all accruals. Our job was to identify accruals and deferrals for the Walmart for year 2015. Here is the asset side of Walmart, and let's see whether we can identify any deferrals or accruals. The first thing that you need to notice here is prepaid expenses and other. The amount is $2,224. Here we see a form of deferrals. Basically, Walmart paid in advance for the rent of some of its superstores. The next thing that you should notice here is other assets and deferred charges. This is under long-term assets, and the amount is $5,671. So you need to look at the details on what exactly is included here. There are many things included here. This is a catch-all account, but the most important thing from our purposes is deferred charges. And under deferred charges, the most important thing that Walmart has is prepayment of some taxes in advance. How about liability side? Under liability side, we have 3 forms of accruals and deferrals. The first one is accrued liabilities of $19,152. Let me remind you one more time, all of these numbers are in millions. So basically, Walmart has accrued liabilities of $19 billion. So what is in here? There are many things here, but the most important one is wages. Basically, employees work for Walmart, they are not paid yet, and it is recorded as an accrued liability. The second one is accrued income taxes. The amount is 1,021. As you can understand from the name, here we have Walmart. It is supposed to pay tax to governmental authorities. They didn't pay it yet, therefore it is recorded as accrued income taxes. And similarly, we also have deferred income taxes and other of 8,805. This is the same as accrued income taxes, but notice that it is under long-term liabilities. So basically, Walmart is supposed to pay to government authorities at least 8,805 for its tax expenses. The second accounting concept that I would like to spend some more time on today is conservatism principle. It's a very, very important principle of accounting. Let's just go through one more time what conservatism principle here is. Under conservatism, revenues are recognized only when they are earned. So basically, you have to be sure that revenues are earned. On the other hand, losses are recognized even if there is some uncertainty that whether the losses exist or not. Conservatism principle is applied in financial accounting through provisions. Under provisions, we reduce the value of an asset or create a liability, and at the same time, we book an expenses. Some of the examples are provisions for account receivable, provisions for inventories, warranties, or contingent losses. We are going to spend some more time about provisions for account receivable, inventories, and warranties. Therefore, what I want to do is that I want to show you how provisions are applied through the lens of contingent losses. Here's my question. There is a firm, it is sued for $1 million due to an environmental issue in year 2015. So notice, let's just discuss what's going on here. We have a firm, it is sued for $1 million for an environmental issue. Is firm supposed to pay $1 million yet? Not really. Lawsuit is still continuing. It's quite possible that the firm can win the lawsuit and it doesn't have to pay anything. On the other hand, the firm can lose the lawsuit, but it's not guaranteed it's supposed to pay $1 million. It can pay $500,000, it can pay $2 million. So as you can imagine, there is a lot of uncertainty here whether this liability exists or not. But we are going to apply conservatism principle. Under conservatism, even if there is some uncertainty that the losses will happen, we book them. So how are we going to do that? But as soon as we learn that the firm is sued and firm can lose $1 million, we are going to create an expense of $1 million on the income statement because of conservatism principle. But firm is not supposed to pay this yet, and firm didn't pay it yet. So how are we going to book this? What is the other side of this transaction? We are going to create a provision. Basically, in particular, this is a provision for contingent losses. Let me spend some time on what contingent loss mean. Here, contingent loss mean we are talking about an event, we are talking about the loss, but its existence will depend on some other events. For example, in this question, the firm is supposed to pay $1 million only when if it loses the lawsuit. Otherwise, it doesn't have to pay anything else. So the contingency here is whether the firm is going to lose the lawsuit or not. All right, the year end comes. We need to transfer the balance on the income statement to retained earnings. So as you can see here, the transfer, we have a $1 million loss in income statement, which is transferred to retained earnings. And at the end of the year, we have a provision for contingent loss of $1 million. It's a liability. And at the same time, we have a $1 million loss under retained earnings. Next year comes, the firm settles the lawsuit for $500,000. So how are we going to go ahead and book this? First of all, notice that this is not the first year of operation. Therefore, we have some opening balances. The opening balance of provision for contingent losses of $1 million, and we have an opening balance of $1 million loss under retained earnings. Since the lawsuit is settled for $500,000, there is a cash outflow of $500,000. So here is a cash reduction of $500,000 on the asset side. Second of all, we need to close the provision for contingent losses because you don't need this provision anymore. Lawsuit has ended. We don't need this. So you close the provision for contingent losses. You put a minus $1 million. And then if you just step back and look, it doesn't balance. What was the fundamental equation, accounting equation? Assets are equal to liabilities plus shareholders' equity. On the asset side, you have a loss of $500,000. On the liability side, you have a loss of $1 million. How are you going to make it balance? To make it balance, you are going to book a gain of $500,000 under income statement. Basic idea here is that last year you were very conservative. You took a loss of $1 million. Actually, the amount of loss was just $500,000. Therefore, you make it up this year by adding $500,000 gain. And then year end comes, you need to transfer the balance on income statement to the retained earnings. As you see, on the income statement, we have a $500,000 gain, which is transferred to retained earnings. And at the end of year 2016, we have $500,000 reduction in cash balance, and we also have $500,000 loss on the retained earnings. The point I'm trying to make here is that this is how we deal with an uncertain liability. We are conservative. No matter what, we book it, and according to what the outcome will turn out, we are going to use this provision or not. Now it's the perfect time to discuss about revenue recognition principles. In particular, we are going to talk about when a firm is supposed to book revenues, and second of all, we are going to discuss principles of revenue recognition. Why this is a very big deal? Under revenue recognition, we are talking about when a firm is supposed to book revenues on its income statement. And depending on the timing, the firm profitability will change a lot. Therefore, we got to be very careful on where we are putting revenues on the income statement. The two main principles of revenue recognition are revenue should be earned. Basically, the firm is supposed to provide all the services for this revenue to be earned. And second of all, the amount of revenue needs to be measurable. We need to have a very good figure on what the amount of revenue should be. Let's see some real-life examples of how firms are booking their own revenues. Here is our classic example, Walmart, Sam's Club, and it looks like they have two forms of revenues. The first one is normal grocery sales. And Walmart says the company recognizes sales revenue at the time it sells merchandise to the customer. Does that make sense? It does. As soon as they sell merchandise to the customer, the job of the Walmart is done. From now on, customer will ship. This goes to their own home and consume. On the other hand, there is a second form of revenues for Walmart Sam's Club, which is membership fees. If you want to shop something from Sam's Club, you need to be a member of this club. And for the membership, what you do is that in advance, at the beginning of the year, you pay some dues. The question here is, when does Walmart recognize these dues as a revenue on their income statement? And if you read the statement from Walmart, it says the company recognizes membership fee revenue both in US and internationally over the term of the membership, which is typically 12 years. So basically, suppose that the membership fee is $120. Walmart is telling us that they are going to recognize $10 each over the next 12 months. And does that make sense? It does. Walmart is charging this membership fee as like an access fee to Sam's Club for the privilege to buy from the Sam's Club. Therefore, it is able to book $10 per month as a revenue coming from giving this privilege to two customers. Here's another example of United Airlines. The company records passenger ticket sales and tickets sold by other airlines for use on United as passenger revenue when the transaction and the transportation is provided. Does that make sense? It does. So basically, United is flying their passengers, they land, they deliver all those suitcases of these passengers, and then are they done? Yes. And then they can recognize their revenue on their income statement. Here is another example. Let's see how Apple books revenue. Basically, we can look at the last statement here. It says the product is considered delivered to the customer once it has been shipped, and the title, risk of loss, or rewards of the ownership have been transferred. And at the same time, for most of the company's product sales, these criteria are met at the time the product is shipped. Basically, Apple telling you is that they recognize revenue whenever they ship products to their customers. Whenever they ship, from the perspective of the Apple, their job is done. They ship the product. It is now the responsibility of the carrying firm. Therefore, they can book revenues. There are some industry variation on how the revenues are booked. yes, we have two main principles. It applies to most of the industries, but also other industries, our main principles do not hold. For example, long-term contracts. Let's talk about a construction firm constructing a bridge which is going to last for 10 years. If we apply our principles, then the construction firm needs to book the revenue at the end of year 10, which is a long period of time without any revenue. So for these long-term type of contracts, firms are allowed to book revenues according to the percentage of completion method. Basically, if they finish half of the project, then they can recognize half of the revenue. If they finish 75% of the project, they can recognize 75% of the revenue agreed upon. And this is just applicable to these industries with long-term contracts or projects. The second interesting variation here is natural resources and agricultural products. For example, let's talk about an oil extracting firm. These firms can recognize revenue as soon as they extract oil out of ground. Why is that so? Just notice that there is still no sale. It's just they just extract the oil, and as soon as they do that, they can recognize the revenue. The basic assumption here is that for agricultural products as well as natural resources, the assumption is they can sell these resources in the market quite fast and soon. Therefore, as soon as you get this out or as soon as you harvest these agricultural products, it is as if you already earned the money. But these are exceptions. Our general principles of revenue recognition still remains. Revenue should be earned and measurable. There are many issues in revenue recognition, especially for new age firms, for high-tech firms. Here is an issue provided by Apple. The idea here is that let's say we are buying a MacBook from Apple. When you are buying a MacBook from Apple, you buy the hardware, you buy the software, you also buy the right to get free updates, free upgrades over the next few years. We have an idea about what is the cost of a hardware. We have an idea about what is the cost of a software. But what exactly is the value of these future upgrades, which can be just one, which can be many? Therefore, when Apple is booking revenues, they have to worry about each of these three components. When they sell MacBook, they can easily recognize the value of the hardware. They sold it. When they are selling MacBook, they can recognize the value of the software. Most of the time, software can be also sold separately. But they need to also attribute some value to the future upgrades that they are going to provide the customer. And here where the issue is, this is not a certain number. You can say $100, you can say $10, and nobody can argue with you. And this is a potential issue. Basically, when Apple is selling this MacBook, they need to recognize some of this sales revenue as a value for potential future upgrades. And what are they going to do with this revenue? It is going to be first recorded as unearned revenue. And as soon as these upgrades are provided, they will be earned. And they are going to also estimate a time period when these upgrades will be provided, let's say over the next 5 years. And therefore, Apple is going to recognize the unearned revenues associated with these future upgrades over the next, let's say, 5 years. The point I'm trying to make here is that, as you see, this is a very judgment-related issue. You can decide it is 1 year, 5 year, $100, $200. And it is at the judgment of the Apple, industry practices, and at the judgment of auditor. The problem with Apple was a quite innocent one. It has some future upgrades, and it needs to estimate the value of these future upgrades. But there are also some frauds happening in revenue recognition. And here is an example for you. Sunbeam is a small appliance maker which filed for bankruptcy in year 2001. Why? Because this firm engaged in severe revenue recognition principle violations between year 1996 and 1998. What happened? For example, they ship more goods than ordered by the customers so that they can book more revenues than should be. Second of all, they ship goods even if the orders are cancelled. There is no order, they ship the goods so that they can book revenues. The third one is quite interesting, something called bill and hold. Here they sell goods under an early buy program where retailers can pay 6 months later, and then the goods are stored in Sunbeam's warehouses. So what's happening? Sunbeam is selling some goods which is not paid by the customers. It is not shipped, it still stays in the warehouse of the Sunbeam, but still Sunbeam is showing them as a sale, and therefore they are booking revenues. The last practice is also very interesting. This happened especially for the transactions between Sunbeam and Walmart. Sunbeam book a sale and ship the goods to a warehouse rented by Sunbeam. So Sunbeam is selling goods, they are not collecting any money, they are shipping it, that's fine, but they are shipping not to the customer's warehouse. They are shipping to a warehouse rented by Sunbeam to show that they shipped so they can recognize the revenue. But in reality, if you just step back and look, there is no sale at all. This is not shipped. They didn't transfer the title of the goods, therefore they are not supposed to book these revenues. The point here is that revenue recognition principles are widely violated, especially until year 2000s. From now on, we are much more careful on whether revenue is earned or not. But if you again look back, some of the accounting scandals, they are very much associated with revenue recognition principle violations. Here is a brief summary of what we have done in module number 3. First, we talked about the fundamental accounting concepts, and then we spent extra time on accruals principles, deferrals and provisions, and finally we talked about the main principles behind revenue recognition. In the next class, we are going to talk about accounting for short-term assets. Short-term assets are the assets which has a life of less than 1 year. In particular, we are going to talk about account receivables and inventories. And until next time, take care. Now it's a good time to go through cases for Module 3 content. Here is my first case. Ring the Bells Incorporated provides doorbell repair services to customers. On December 5, 2018, Ring the Bell provides services worth $27,050 on credit to customers. On December 13, Ring the Bells collects $14,280 in cash from the customers for services performed on credit in December 2017. On December 19, 2018, Ring the Bells collects $11,060 in cash for services which will be provided next year, January 9, 2019. Accordingly, here is the question number 1. How will this transaction affect this company's balance sheet at December 31st, 2018? Ignore any tax. First of all, cash will go up by $25,340. Where is this coming from? It's coming from two things. First, we collected $14,280 for work which has been completed in December. We also got some advance payment of $11,660 for work that's going to be completed in the next year. Second, account receivable will go up by net $12,770. Why? Because initially it was there was an account receivable creation of $27,050, out of which our customers paid $14,280, and net increase in account receivable is $12,770. Next, we need to create unearned revenue for cash payments, a cash advance payment, $11,060. Customers paid to us, but we didn't provide them any service yet. Therefore, unearned revenue should go up by $11,060. Finally, retained earnings will increase by $27,050. It is coming from on December 5th, 2018. We provide services to customers worth $27,050. Here is the second question. How will this transaction affect this company's income statement for the fiscal year ended 2018? It is just like the retained earnings before. Income will go up by $27,050. This is the amount of services we provided our customers. Finally, what transaction will ring the bell records when the services provided to customers on January 9, 2019? When you provide the service for which you already get the advance payment, you reduce and close down on revenue, decrease by $11,060, and then you create a revenue on your income statement by $11,060. Notice that here there is no impact on cash because cash has already been collected in year 2018. Here is my second case. Costco and its subsidiaries operate membership warehouses. Costco accounts for membership fee revenue, net of refunds on a deferred basis, ratably over the 1-year membership. So whatever the membership fees they got initially, they just recognize this revenue over the next one year because membership fees are paid for a year. The following table details deferred membership fees and the amount of revenue recognized for fiscal years 2016, 17, and 18. So let's just see them. The first table here says, excerpt from Costco Wholesale Corporation's consolidated balance sheets from their 2018 and 17 annual reports, amounts are in millions. What do we have here? For years 2018, 17, and 16, we have deferred membership fees. So you can think about this as honored revenues coming from the balance sheet. The second table here is, it says again for the same years, 2018, 17, and 16, what does it say? Consolidated statement of income from their 2018 and 17 annual reports. So basically, these are the amount of membership fees revenue recognized on their income statements in these 3 years. For example, in year 2018, the amount of membership fee recognized is how much? 3,142. So accordingly, here is question number 1. What is the amount of Costco membership fees recorded as revenue for fiscal year 2018? As just like what I said before, the amount here is 3,142. Why? It is coming from the second table. Second table explicitly tells you these numbers are coming from consolidated statement of income. This is the amount of income recognized on income statement. Here is question number 2. How much of the membership fees recorded as revenue in 2018 is related to memberships initiated or renewed during year 2017? The answer is 1,498. Where is this coming from? It is coming from last year's annual revenue. Last year's annual revenues, 1,498. These are annual memberships. So whatever is the annual revenue of last year will be totally recognized in this year. And that's what the question is asking. Out of the membership is recorded as a revenue, how much is coming from the cash collections of last year? That's going to be 14,098. And here is the third question of the second case. What is the total amount of membership fees collected in fiscal year 2018 on membership initiation and renewals? What percentage of these fees were also recorded as revenues in year 2018? In other words, the question is asking you to go through unearned revenue account one by one. How does unearned revenue account change? There's beginning unearned revenue. Unearned revenue will go up by membership fees collected, which is what the question is asking you. Unearned revenue will go down by membership fees recognized as revenue. And finally, we are going to come up with the ending amount of unearned revenue. Beginning and ending unearned revenue is coming from the first table here. The beginning amount of unearned revenue is 1,498. The ending amount of unearned revenue is 1,624. And we also need membership fees recognized, which is coming from the second table here, 3,142. If you put everything together, the amount of membership fees collected is how much? 3,268. Second part of this question is asking you what percentage of these fees was also recorded as revenue in year 2018. So in year 2018, we collected from customers 3,268. How much of this also recorded as a revenue in year 2018? Well, we know that in year 2018, the amount of membership fees recognized is 3,142. Out of 3,142, 1,498 is coming from last year. Therefore, their difference must be coming from this year's membership fee collections. And then you divide it by the total amount of this year's collections, which you have just calculated, 3,268, and you find about 50%, which makes sense. All right, so it is recognized 50-50. And here's an interesting question. Let's just read it super carefully. All right, this is probably the toughest question of this case, or maybe these entire cases in this module. Suppose that an alternative accounting treatment of Costco membership fees was to record them as revenues when memberships are initiated and renewed. The question is telling you that suppose that there is no unearned revenue at all. Whenever you get cash from the customers, you record immediately as revenue. All right, so you don't worry about revenue recognition principles. Had this alternative treatment been used, would net income, total assets, liabilities, and shareholders' equity in fiscal year 2018 be higher than, lower, or the same as the amounts that have already been recorded? First of all, if this alternative method had been used, net income would be how much? 3,268. Why? This is the amount of cash collections from customers that we have collected in this question, right? Let's just go to previous question. What was the amount of cash collections from customers in year 2018? 3,268. So if you use the treatment that whenever you get cash from customers, you recognize a revenue, your revenue for year 2018 will be 3,268. And there will be no deferred membership fees recognized on the balance sheet. Therefore, your net income will be higher. Why? Your net income will be, in this alternative treatment, 3,268. Original, the amount of membership fees recognized is 3,142. Your net income will be higher. How about your total assets? Total assets will not change, all right? Customers always pay, their cash always goes up. What we are dealing with here is when they pay, should we record an unearned revenue or not? Okay, therefore there will be no impact on total assets. How about liabilities? The liabilities will go down. Why? Because you don't have any more unearned revenue. And then finally, what happens to shareholders' equity? Well, let's just look at this. Total assets is the same. Liabilities goes down. In order for fundamental accounting equation to hold, your shareholders' equity should be higher. Now, some people find this confusing, right? So, oh, net income is higher. How come shareholders' equity is also higher? Notice that the question is telling you that had this alternative treatment been used, this treatment is used not just this year, right? This treatment is used from the start of the Costco's establishment. Therefore, in this year, yes, net income can be higher, and you might think that shareholders' equity will also be higher, but don't confuse yourself. We are not calculating it that way. We are calculating it from the fact that total assets doesn't change. Liabilities will go down, therefore shareholders' equity should be higher to compensate for lower liabilities. It's nothing to do with net income being higher in this year. This treatment has been changed throughout the company's history, right? Therefore, by looking at the net income higher this year, you cannot say that shareholders' equity should also be higher. And here is the third case about Economist Journal. It's an international business covering publishing, the supply of business information. One business segment of the Economist group includes the Economist magazine, which is sold on a subscription basis. Note 18, trade and other liabilities from the 2018 annual report of the Economist group is presented on the next page. Using the information provided, please answer the following question. Assume that the entire balance of deferred income relates to the Economist magazine subscriptions. And here is note 18, trade and other liabilities of Economist. All of these numbers are in £1,000. Question number 1. When do you think that the Economist group recognizes revenue for the subscriptions for Economist magazine? Assume that all subscribers pay all subscriptions in cash in advance of receiving them. Of course, we are going to recognize the revenue as magazines are delivered monthly. People can pay in advance, it doesn't matter. We are going to record them as first deferred or unearned revenue, and we are going to recognize revenue over time. Question number 2. The Economist Group's fiscal year ends on March 31st each year. As of March 31st, 2018, what was the total value of magazine subscriptions that had been sold but that Economist Group hadn't yet recognized as revenue? Here I am asking you, what is the amount of unearned revenue? And that number is 114,435. It's coming from two sources: current deferred income, 102,001, and non-current deferred income, 12,434. And these numbers are clearly identified in note 18 in red rectangles. Question 3. Assume that the revenue recognized for magazine subscriptions during the fiscal year 2018 was $261,926,000. Estimate how much Economist Group collected during the year in cash. In order to answer this question, we are going to go through how deferred income or unearned revenue account changes. There is beginning unearned revenue. Unearned revenue will go up with cash collections from customers. That's what the question is asking you. Unearned revenue will go down with revenues recognized during the year, which is given in the question as 261,926, and then you come up with the ending unearned revenue of 114,435, which we have calculated in the previous question. The beginning amount of deferred revenues coming from last year's current and non-current deferred revenues. And if you do the algebra, the amount of cash collections from customers in year 2018 becomes 251,422. Here is case number 4. Suppose that on November 27, 2016, Run a Ground company pays $24,000 in cash in advance for a new insurance policy which will cover the 6-month period beginning on December 1st, 2016. So it's covering December of 2016, January, February, March, April, May of 2017. On December 19, 2016, this company pays $16,840 in cash to employees for work done during the 2-week pay period of December 5, December 19, 2016. On December 28 of again 2016, this company receives a bill of $230 from the utility company for December's utilities. The utility will not be paid until January 10, 2017. The first question is, how will these transactions affect this company's balance sheet for the fiscal year ended December 31st, 2016? Don't worry about tax. 1. Cash will go down by how much? 40,840. Why is this happening? Because we have 2 cash payments. First of all, we pay for $24,000 in advance for what? New insurance policy. We also pay $16,842 to employees for wages. Second, your prepaid insurance will increase by $20,000. Why not 24? Remember, this prepaid insurance covers 6 months starting in December. 24,000 divided by 6 is 4,000 every month's insurance premium. Out of 24,000, 4,000 has been used for December 2016. Therefore, the remaining amount is 20,000. Utilities payable. We got a bill. We didn't pay it yet. Therefore, it's going to be recorded as 230 utilities payable. Finally, what is the impact on retained earnings? There will be a decrease of 21,070, which is coming from 3 sources. 1, the first one, 16,840 is wage expense. 230 is utility expense. And 4,000 is this year's insurance expense. How will these transactions affect this company's income statement for the fiscal year ended 2016? It is just like the retained earnings of previous question. There will be a decrease of 21,070. And finally, what transaction will this company record when the insurance policy expires on May 31st, 2017? Well, we are going to now fully use this insurance policy. Therefore, prepaid insurance will be decreased by 20,000, and you are going to create an insurance expense on the income statement by 20,000. And here is my 5th case. BJ's Wholesale Club is a leading warehouse club operator on the East Coast of the United States. BJ's charges a membership fee to its customers, and they recognize membership fees on a straight line basis over the life of membership, which is generally 12 months. The following table details the deferred membership fee income and the amount of revenue recognized for fiscal years 2018 and for fiscal year 2019. Let's just look at this graph a little carefully. What is going on here? The title here is Note 16, Accrued Expenses and Other Liabilities of BJ's Wholesale Club 2018 and Annual Report. It says the following table summarizes the membership fee income activity for the last 2 years. What's the first line? Deferred MFI. MFI stands for membership fee income, beginning of the period. cash received from members, revenue recognized in earnings, which reduces the amount of unearned revenue, therefore it's negative, and you come up with the ending deferred MFI, membership fee income, of 134,415, which is going to be the ending balance in year 2019. Here is question number 1. What is the amount of BJ's membership fees recorded as revenue for fiscal year ended 2019? That amount is 282,893. You can find this number on the note 16. It is in rectangle. It explicitly says that the amount of revenue recognized in earnings is 282,893. Question number 2. How much of the membership fees recorded as revenue for the fiscal year ended February 2019 is related to membership fees initiated or renewed in last year? So basically, we need to use the last year's ending or this year's beginning deferred unearned revenue. How much it is? That number is 126,216. Membership fees are for a year. Whatever is paid and not recognized last year will be recognized in this year. Here is the third question. What is the total amount of membership fees collected in fiscal year 2019? What percentage of these fees was also recorded as revenue again in year 2019? Well, the statement explicitly tells us that the amount of membership fees collected is 291,092. And second part of this question is, how much of this membership fees collected in year 2019 is also recognized as revenue in again 2019? Well, let's look at the last line here. In year 2019, the amount of revenue recognized is how much? 282,893. Out of this, 126,216 is coming from last year's collection. Therefore, the difference must be from this year's collection. Divided by this year's total collection, 291,092, you find 54%. And here is our tricky question here, just like we have done before. In question number 2, we have an alternative treatment for this unearned revenue. What is it? Suppose that an alternative accounting treatment of BJ's Wholesale Club membership fees was to record them as revenues when memberships are initiated or renewed. So there is no unearned revenue. Okay? So if this happens, what will be the impact on assets, liabilities, and shareholders' equity and income? Well, if this alternative treatment had been used, the amount of income in year 2019 will be cash collected from customers. It's going to be 291,092, and we will have no unearned revenue. Accordingly, your net income will be higher because you collected this year 291,092. And if you look at the statement, normally it says that the amount of revenue recognized in earnings in year 2019 is 282,893. Your total assets doesn't change. Customers always pay. Our question here is whether it's unearned revenue or revenue. Liabilities will be lower. Why? There is no unearned revenue. And again, I'm going to use the fundamental accounting equation. Your total assets doesn't change. Liabilities are lower. Therefore, shareholders' equity must be higher. And here is the last case of this module. It's about Meredith. And let's just read the story of this company. This company is a diversified media company. The company's national media segment includes print magazines, digital and mobile data, media, brand licensing activities, affinity marketing, etc. An excerpt of the balance sheet of Meredith Corporation is presented in the next page using the information provided. Please answer the following question. Assume that the entire balance of unearned revenues relates to magazine subscriptions. And here is the balance sheet of this company for year 2018 and 17. Our focus will be on unearned revenue. Notice that unearned revenue could be current or long-term. Question number 1. When do you think this company recognizes revenue? Just like before, as magazines are delivered monthly. You can collect the money in advance, it doesn't matter. Revenues will be recognized when the magazines are delivered monthly. Question number 2. Meredith Company's fiscal year ends on June 30 each year. As of June 30, 2018, what was the total amount of magazine subscriptions that had been sold, but the Meredith Corporation hadn't yet recognized as revenue? So I'm asking you, what is the amount of unearned revenue? That number is 484.5 million. It's coming from current unearned revenue and long-term unearned revenue, as you can see on the balance sheet in red rectangles. Question number 3. Assume that the revenue recognized for magazine subscriptions during the fiscal year ended is how much? 489.3 million. Estimate how much Meredith Corporation collected from customers during year 2018. In order to answer this question, we need to go through how unearned revenue can change. There is beginning unearned revenue. Unearned revenue will go up with collections during the year from the customers. That's what we are after. Unearned revenue will go down by revenues recognized during the year. And finally, we come up with the ending unearned revenue, which we have calculated before as 484.5. What is the beginning amount of unearned revenue, which you are going to sum current and long-term unearned revenue of year 2017, and you're going to find 325.5 million. And you have the revenue recognized during the year, which is given in the question as 489.3. And if you do the algebra, the amount of cash collections from customers is how much? 648.3 million. This completes my cases for module number 3. Thank you. Hello, welcome to Module 4 of Financial Accounting Foundations here at University of Illinois. Today, we are going to talk about short-term assets. In particular, we are going to go through accounting for account receivables and accounting for inventories. So what's a short-term assets? By short-term assets, we are talking about assets on a balance sheet which can be converted into cash within a year. In accounting, we generally assume that accounts receivables and inventories are short-term assets because most of the time, but not all, they are converted into cash within a year. The first group of short-term assets we are going to talk about in this class is account receivables. So what's an example here? For example, there is a firm which is making a sale of, let's say, $1,000, but it doesn't collect the money from the customer at the time of sale. Then this $1,000 will be recorded as an account receivable on the balance sheet. So the question now is, how do we value account receivables? Account receivables are not valued at their face value. In the example that I just gave you, it's quite possible that the value that you see for the account receivable on the balance sheet may not be $1,000. Instead, account receivables are valued in terms of their net realizable value. Net realizable value is equal to face value. In the example I just gave you, it is $1,000 minus 3 things. These are cash discounts, sales returns, and bad debts. Now we will spend some time on these 3 terms. The first term that we have just mentioned is cash discounts. What's the cash discounts? These are discounts given to customers over sale price if they pay within a certain time period. The main purpose of the cash discounts is to encourage customers to pay early. Let's give an example. Here I have Elina Supermarket, which sells goods worth $2,000 to a customer on credit. That's why it is account receivable. On January 1st, 2016, based on some terms. These are 315 and N30. So let me just explain. Let me start with the second one. N30 means this receivable needs to be collected within 30 days. The first time, 315 means, on the other hand, if the customer pays within 15 days, customer will get 3% cash discount. And it turns out that customer makes the payment on January 10, 2016. In other words, customer pays within 15 days, and customer is entitled to this cash discount. So how do we do the accounting for this? First of all, we record the sale. So on the income statement, IS column, there is an increase of $2,000. This is the amount of sales. And at the same time, on the account receivable column, AR, we have $2,000 increase. This is on January 1st, 2016. On January 10, 2016, what happens is that customers pay all of these receivables. But since the customer pay early, he is entitled to a certain amount of discount. What is the size of this discount? Which is the last column here. It is $2,000 times 3%, which is 60. And the 60 is recorded as a negative, as a minus from income statement column. In general, we consider the $60 of cash discount as a reduction from sales. Second of all of the account receivable disappears because the customer makes the payment. And finally, what is the amount of total cash collection? It is $2,000, which is the amount of face value of the receivable minus $60 of cash discounts. So as you can see here, the value of the account receivable that on the balance sheet may not be $2,000. It is $2,000 minus cash discounts. The second reason why there is a difference between face value of account receivable versus what you see on the balance sheet of account receivable is sales returns. Sales returns occur whenever customers return their goods within a certain time period. And when they return in this time period, they are entitled to full refund. How do we do the accounting for sales returns? So basically, firms need to estimate expected amount of sales returns, and they need to create a provision for this. This provision is called sales return allowance. This is a very different, very interesting account. First of all, it's a contra asset account. What does this mean? It's an asset account because it is very much associated with account receivable, but it's a contra one, meaning that when you see the number for sales return allowance, it is going to have a negative number. And we will see an example soon. And when sales return allowance is reported to outsiders, we may not see this on the balance sheet. Instead, it is netted against account receivable balance. Let's give an example. Elina Supermarket makes a total sale of $50,000 in January 2016. Customers are allowed to return the goods within 30 days. Elina Supermarket expects 5% of the goods to be returned based on past experience. How do we do the accounting for this? First of all, we create sales. So income statement goes up by $50,000, and at the same time, we create account receivable of $50,000. But we know that out of this $50,000, it is very much possible that 5% can be returned. Therefore, what do we do? As soon as we record sales, we record also sales return allowance. How do we do that? First of all, 5% of $50,000 is $2,500. First, it is recorded as a negative, as a reduction from income statement. And it's a reduction from sales. And at the same time, you create sales return allowance. It is again a negative number of $2,500. Notice that sales return allowance is an asset account. It is on the asset side, but its value is negative. That's what we mean by contra asset. It's an asset, but its value is negative. So what is the impact of sales return allowance? It's a provision account, and provisions are generally used to absorb future losses. It means that from now on, if there is any sales return, we are going to use the sales return allowance account to record these new sales returns. So here is the second part of the question. Elina Supermarket customers return goods worth $1,000 in the first week of February 2016. So how do we record this? First of all, there is a reduction of $1,000 from account receivable because these account receivables are no longer payable by customers. The second leg of this transaction is recording a positive $1,000 on the column of sales return allowance column. Notice that this is a quite interesting account. Sales return allowance is a negative number, $2,500. You are adding $1,000 to this column. In other words, you are using this provision for actual sales return. The third reason why there is a discrepancy between account receivable that you see on the balance sheet versus the face value of account receivable is bad debts. Bad debts occur whenever customers cannot pay. What is the impact of bad debts? First of all, since customers are unable to pay, this account receivable needs to be written off. So the account receivable balance is reduced. At the same time, we took a loss on income statement for this non-payment. Just like sales returns, for bad debts, we need to create a provision. We need to estimate the amount of bad debts, and we need to create a provision. So how do we estimate the amount of bad debts? There are many methods. Some of them are percentage of sales method, aging schedule, and specific account analysis. For this class, we are just going to focus on percentage of sales method because it is the most common used one. So how do we calculate bad debts under the percentage of sales method? Under this method, provision is a certain percentage of total amount of credit sales. So where is this percentage coming from? It can come from other firms' own experience, or it can come from some industry practices. So let's do an example. Again, Elina Supermarket makes a total credit sales of $700,000 in year 2015. The market collects $500,000 by the end of year 2015. So $200,000 of account receivable is remaining to be collected in year 2016. Expected bad debt rate is 5% of credit sales. So how do we record this? First of all, there is a sale of $700,000 in year 2015. Therefore, account receivable goes up by 700 and income statement goes up by 700. That is sales. Second, out of the 700, Elina Supermarket is able to collect $500,000 in year 2015. Therefore, there is a cash increase of 500 and there is a account receivable decrease of $500,000. We come to the year end. We know that out of total account receivables, 5% may not be collectible due to bad debts. Therefore, we need to create a provision. The provision that you create for bad debts is called provision for doubtful accounts. What is the size of this provision? It is $700,000. This is the total amount of credit sales times 5%. It's going to end up with $35,000. And at the same time, you record $35,000 under income statement column. So this is called bad debt expense. The number that you see under income statement column for $35,000 is bad debt expense. It's a part of administrative expenses. It is not a reduction from sales. So the year end comes. We know that when the year end comes, we need to transfer the balance from income statement to retained earnings. What is the total balance on the income statement? It is $700,000 minus $35,000 of bad debts, which is going to give you $665,000. It is transferred to retained earnings, and here are ending balances for year 2015. Cash is $500,000. Account receivable is $200,000. Provision for doubtful accounts is $35,000. Negative. It's a contra asset. And finally, retained earnings is $665,000. So next year comes, Elina Supermarket collects $100,000 from debtors in year 2016. In addition, debtors who owe $20,000 go into bankruptcy. Okay? And Elina Supermarket is able to get $5,000 from these bankrupt debtors. How do we record this? First of all, we start with the beginning balances. These are the ending balances of last year. Exactly, I copied what's going on there. Out of this $200,000 of receivables, Elina Supermarket collects $100,000. Cash goes up, account receivable goes down. And next, we know that one of our customers go into bankruptcy. And the size of their receivables is $20,000. Since the customer goes into bankruptcy, this account receivable is no longer collectible. Therefore, there is a reduction of $20,000 from account receivable. But we know that somehow we recover $5,000 from them. Therefore, there is a cash increase of $5,000. So it looks like because of this customer, we have a loss of $15,000. And this loss is recorded under provision for doubtful accounts. So provision is here is a safety account. It has been created last year to absorb future losses. The first losses this Elina Supermarket faces is $15,000, and $15,000 is recorded as a reduction from provision for doubtful accounts. In other words, provision for doubtful accounts absorbs this loss. Year end comes. We need to transfer the balance to retained earnings, but there is nothing on the income statement to be transferred. And here are ending balances at the end of year 2016. So notice that the new balance of provision for doubtful accounts is $20,000, which can be used to record future losses. So how do we record account receivables in real life? So here is an example from Walmart. I just focused on asset side of Walmart at the end of year 2015. The account that we are interested in receivables, net. First of all, what do we mean by net? Here we talk about gross receivables, net of provision for doubtful accounts, as well as provision for sales returns. As we have mentioned before, these provisions are contra assets accounts. They have a negative balance, but when you are recording the balance sheet, they are not recorded separately. They are part of receivables. That's why you see here account receivables net. It is net of provision for doubtful accounts as well as provision for sales returns. So what is the size of this account receivables net? 6,778. Notice one more time that all of these numbers are in millions. So basically, by the end of year 2015, Walmart expects to collect from customers $6.8 billion. Let's do a couple of exercises about Walmart. Suppose the total provision for sales return is 100 and total provision for doubtful accounts is 400. The question here is, what is the percentage of total account receivables Walmart doesn't expect to collect at the end of year 2015? So how do we solve this problem? First of all, we are interested in the amount of receivables that Walmart doesn't expect to collect. So it's calculated as the total amount of provisions. That's why we create the provisions. These are provisions for sales returns. We don't expect to collect the sales return. And provision for bad debts. Again, bad debts will go sour. We will not be able to collect them. So it's calculated as provisions divided by total account receivable. It is not net account receivable. It is total amount of account receivable. So how do we calculate this? First of all, the amount of total provisions is 100. It's a provision for sales return, and 400 is provision for doubtful accounts. The denominator here is total account receivable. Total account receivable is equal to net account receivable, which is 6,778 we have seen in the previous slide, plus $500 of total amount of provisions. We know that provisions are recorded net on the balance sheet. So in order to calculate total amount of account receivable, I need to add back provisions. So if you add back $500, the total amount of denominator becomes 7,278. 500 divided by 7,278 is 7%. So in other words, by the end of year 2015, Walmart doesn't expect to collect 7% of its total accounts receivable. Here is another example. Suppose that the provision for doubtful accounts at the end of year 2014 is 510. Notice that in the slide of Walmart, we were talking about 2015 numbers. So this is amount of provision for doubtful accounts at the end of last year. And suppose also that the amount of bad debt expense in year 2015 is 20 million. So what is the amount of account receivables that are written off? To calculate this, we need to go through provision for doubtful accounts. Provision for doubtful accounts has the following components. First of all, there is a beginning amount of provision. It is given in the question as 510. The provision amount will go up whenever you have any bad debts, and it is given in the question as 20. Provision will go down whenever you write off some account receivables. That is what is being asked in the question. That's why I have a question mark. And you come up with the ending amount of provision, which is $400 given in the previous slides. So if you go through these calculations, 510 minus 20 plus the amount of accounts receivables written off is equal to ending amount of provision, which is minus 400. Then you're going to find that the question mark is $130 million. So Walmart writes off, in our hypothetical question, $130 million because they are uncollectible from its own customers. The second group of short-term assets we are going to discuss in this module is inventories. There are many different types of inventories according to type of the business. For example, for manufacturing firms, we have three groups of inventories. The first one is raw materials. For example, for a car manufacturing company, raw material is steel. The second group of inventories is work in progress. Here we are talking about, again, for a car manufacturing company, half-finished cars. And finally, we have finished goods inventory. Here we are talking about fully finished, ready-to-sale cars. On the other hand, for trading companies or retail companies, we have just one group of inventories. These are goods available for sale. For example, for a car dealer, not car manufacturer, for a car dealer, cars sitting in its showroom are considered as goods available for sale. So how do we value inventories? Inventories are valued as the lower of cost, which is how much it costed the business to buy the inventory, or net realizable value, which is how much the business will get if it sells this inventory to outsiders. Therefore, net realizable value for an inventory is calculated as sales price minus sales costs. Inventory values cannot be marked up over cost. So basically, you cannot have a value of inventory on the balance sheet which is higher than the cost. Cost is the upper value of inventories on the balance sheet. Now the question here is, what happens if the net realizable value is less than its costs? Then we have inventory write-downs. Inventory write-down means we are going to reduce the value of the inventory to its own net realizable value, and then we are going to create a corresponding amount of loss, and it is not reversible. We write down this inventory, and then we are going to do all the accounting accordingly. A very important account, which is very much associated with the inventory account, is cost of goods sold. Cost of goods sold is an income statement number. And how do we calculate this? For a retail firm, cost of goods sold is equal to beginning amount of inventory, how much you have at the beginning of the year, plus purchases of new inventory, minus the amount of ending inventory. For example, let's say at the beginning of the year, for a car dealer, we have 10 cars to sell. During the year, we buy 5 more, which makes it 15 cars to be sold. And at the end of the year, it turns out that we have 2 cars left. It looks like the amount of cost of goods sold needs to be the cost of 15 minus 2, which is 13 cars. For a manufacturing firm, it is calculated quite similarly. Again, we have beginning amount of finished goods, plus there is no purchases of for a manufacturing firm, plus there is transfer from work in progress. These are half-finished cars are fully finished and transferred to finished goods inventory, minus we have the ending amount of finished goods. And this is how we can calculate cost of goods sold for a manufacturing firm. Now let me attract your attention one more time back to the retail firms. Cost of goods sold is equal to beginning plus purchases minus ending. So where are these numbers coming from? Beginning amount inventory is quite easy. You look at last year's balance sheet, and that is how you find beginning amount of inventory. Second of all, you can probably easily calculate purchases during the year because you have sales invoice. The question here is, how do I know the value of ending inventory? So the problem is that firms cannot always keep track of their inventory flow. Therefore, they need to make some assumptions about cost flows. The first one is last in, first out. Here you assume that the last unit that you buy during the year are the first unit that you sell during the year. That's an assumption. Second of all, first in, first out, which is FIFO. Here, the assumption here is that the first units that you have in the inventory accounts are the first unit that you sell to outsiders. And finally, we have weighted average method. Here, we are not worried about first or last. At the end of the year, we just sit back, we calculate average value of average cost of the inventory, and therefore we can calculate the ending amount of inventory as well as cost of goods sold. Let's make an example. Here, the question here is we are supposed to calculate cost of goods sold as well as ending inventory for the following stream of inventory transactions. At the beginning of the year, we have 100 units. In January, we sell 80 units. In February, we buy 30 more units. In March, we buy 40 more units. So it looks like at the end of year, we have in the ending inventory 90 units, and the amount of inventory units sold is 80 during the year. The question here is, what is the amount of ending inventory as well as what is the amount of cost of goods sold? First, let's use first in, first out method. The assumption here is that cost of goods sold will come from the first units that you have on your balance sheet. If you go back to our slide, the first unit that we have on our balance sheet are in the beginning inventory. So we are going to assume that all of these 80 units of inventory is sold from the beginning inventory. What is the value or cost of this beginning inventory is $5. Therefore, your cost of goods sold will be 80 times $5, which is 400. And all of them will be coming from beginning amount of inventory. And therefore, the remaining 90 units will constitute your ending inventory. Where is this 20 units, remaining 90 units is coming from? First of all, you have 20 units from beginning inventory. You have 30 units from your February purchase, and you have 40 units from your March purchase. Therefore, your total amount of ending inventory, if you do the calculation, $560. So notice here is that assumption is you are selling first units that you have on your balance sheet. And most of the time, the first unit that you have on your balance sheet are your beginning inventory, which is left from last year. The second cost flow assumption I'm going to discuss with you today is LIFO. LIFO stands for last in, first out. Under LIFO, cost of goods sold comes from the units you buy the latest. On the other hand, ending inventory comes from the units you buy the earliest. So in our example, we have 80 units sold within the year, and we have 90 units remaining in the ending inventory. So if we focus first on cost of goods sold, 80 units will come from the latest units that we have. So what are the latest units we have? Well, first of all, we have 40 units coming from our March purchase. We have 30 units coming from our February purchase, and then we also have 10 units coming from the beginning inventory. And then if you multiply them with their corresponding costs, you are going to come up with 510 as cost of goods sold under LIFO methods. Okay, how about ending inventory? We know that under LIFO, ending inventory will come from the earliest units that you have. So what is the earliest units we have? The earliest units we have are the beginning units we have on the balance sheet. So 90 units, which is the amount of ending units, times 5, this is the cost of beginning units that we have on the balance sheet, will give you 450 as ending amount of inventory on your balance sheet. And here is the last method that we can use, weighted average method. Here we are not worried about first and last. At the end of the year, we just sit back and calculate the weighted average cost of inventory. How do we do this? It is calculated as a total purchase cost of all inventory we have at the end of the year, divided by total number of units purchased. What is the total purchase cost? Which we have inventory coming from beginning. We have inventory purchased in February, and we have inventory purchased in March. And then you just sum them up, their costs. And you divide this by total amount of units purchased during the year. We have 100 units from the beginning. We have 30 units coming from February, and we have 40 units coming from March, which makes it 170 units. So if you do this calculation, total purchase cost divided by 170, you come up with 5.65, which is your average cost of each unit. Therefore, your cost of goods sold is 80 units that you sell times 5.65. Your ending inventory is 90 units sitting in your balance sheet times 5.65. So why do we care about this? Well, according to your cost flow assumptions, some of the numbers, especially on your income statement, can change dramatically. For example, let's worry about cost of goods sold. Let's assume that prices are increasing over time. So we are living in an inflationary country, prices are going up. It means that the last units that you buy in the inventory are more costly than the first units that you have in your inventory book. If that's the case, if you look at cost of goods sold, LIFO will generate higher cost of goods sold than FIFO. Why? Because in the LIFO, you are selling the last units. Therefore, your cost of goods sold will come from the last unit prices. Okay, what's the impact of this? If your cost of goods sold is high under LIFO, then you have less income before tax. If you have less income before tax, you pay less tax, and therefore you have less net income. Since you pay less tax, what happens is that under LIFO you have more cash flows in your hand. And that's the reason why in the United States a lot of firms prefer to use LIFO. Yes, it can generate a lower amount of income, but at the same time it saves you cash. For example, in Europe, which is using IFRS, LIFO is not permitted. On the other hand, if you are using FIFO, you totally have the opposite effects. you pay more tax, but you show more income. And what about inventory balance? If you are using LIFO, you sell the last units you purchased. Therefore, your ending inventory will come from the first units that you have. They are coming from old, outdated costs. Therefore, under LIFO, your ending inventory balance will be low. For FIFO, your ending amount of inventory will be high. Here's a time to see how inventories are recorded in real firms' balance sheet. Here is again our classic example of Walmart assets for year 2015. The account that we will look is inventories. The value at the end of year 2015 is 45,141. Is this a big number? It's a very, very big number. If you look at the total amount of assets, it is a little over 203,000. So basically about 25% of total assets are coming from inventories. That's a huge number. We said that there is a close correspondence between inventories as well as cost of goods sold. Here for Walmart, it is recorded as cost of sales. The amount of cost of sales at the end of year 2015 for Walmart is 365,086. My question right now is, what kind of inventory policies Walmart is using? And for this purpose, we need to look at footnote 1 of Walmart in its annual report. The footnote 1 is called Summary of Significant Accounting Policies. Under inventory section, you have the following. The company values inventories at the lower of cost or market. This is precisely what we have mentioned. We are very conservative. We value inventory either the cost or the market price, which is net realizable value, using the last in, first out method. So basically, Walmart is using LIFO method. As we have mentioned before, the advantage of LIFO is that, yes, you might have less income to report, but you also pay less tax, and therefore you have more cash flows. And just like a lot of other US firms, Walmart is also using LIFO methods. So here is a brief summary of what we have done today. In this module, we learned accounting for receivables as well as accounting for inventories. In the next module, we are going to focus on accounting for long-term or fixed assets. Until that time, take care. Hello, in this lesson I'm going to introduce you LIFO-FIFO conversion. As we have seen in lesson number 7, cost flow assumptions affect a number of financial numbers, including net income and cash flows. This makes it harder to compare financial performance of firms using different cost flow assumptions. Therefore, we need a framework to convert financial statement numbers under a common cost flow assumption. So let me start with this framework so that we can convert numbers under LIFO and FIFO. So let's start with a firm which is using LIFO, and let's see how this firm's inventories change over time. First, we have beginning inventory under LIFO plus purchases of inventory minus cost of goods sold under LIFO is going to be equal to ending inventory under LIFO. Therefore, if you do a little bit of algebra, you will see that purchases of inventory is equal to ending inventory under LIFO plus cost of goods sold under LIFO minus beginning inventory under LIFO. Now, let's do the same exercise for a firm using FIFO. Therefore, beginning inventory under FIFO plus purchases of inventory minus cost of goods sold under FIFO is equal to ending inventory under FIFO. And therefore, again, if you do the similar algebra, you will see that purchase of inventory is equal to ending inventory under FIFO plus cost of goods sold under FIFO minus beginning inventory under FIFO. So if you see these two equations in red, you are going to see that the left-hand side of these equations are purchase of inventory. Whether a firm uses LIFO and FIFO, purchase of inventory will be the same number. Therefore, it must be the case that for these two equations, the right-hand side should be equal to each other. Therefore, ending inventory under LIFO plus cost of goods sold under LIFO minus beginning inventory under LIFO is equal to ending inventory under FIFO plus cost of goods sold under FIFO minus beginning inventory under FIFO. Now I'm going to introduce you a new notion. Suppose that our firm, which is using LIFO, also provides information about inventories under FIFO and also the difference between LIFO and FIFO inventories, which I'm going to call as LIFO reserve. Therefore, instead of ending inventory LIFO, which is the first term in this equation, you can just write that ending inventory under FIFO minus ending LIFO reserve. LIFO reserve is the difference in the inventory numbers between FIFO and LIFO. Similarly, for beginning inventory under LIFO, you can write that it is beginning inventory under FIFO minus beginning LIFO reserve. So if we go to next slide, now we can do some simplifications. On the left hand side, we have ending inventory LIFO, which is equal to ending inventory under FIFO minus ending LIFO reserve. And if you look at the right hand side of the equation, you are going to see another ending inventory FIFO. Therefore, these ending inventory FIFOs cancel each other. Similarly, in the left hand side, we have beginning inventory LIFO, which is equal to beginning inventory under FIFO minus beginning LIFO reserve. Therefore, and we also have minus beginning inventory FIFO in the right hand sides, they will also cancel each other. So let's summarize what we have so far. Minus ending LIFO reserve plus cost of goods sold under LIFO plus beginning LIFO reserve is equal to cost of goods sold under FIFO. Therefore, you can write that cost of goods sold under FIFO is equal to cost of goods sold under LIFO minus change in LIFO reserve. Change in LIFO reserve means ending LIFO reserve minus beginning LIFO reserve. So what is the usage of this framework? Well, first of all, we have seen two things. If our inventory numbers are given in LIFO, if we know LIFO reserve, we can also find inventory numbers under FIFO. Secondly, by using the last equation here, if cost of goods sold number is given in LIFO, we can easily convert it to cost of goods sold under FIFO by differencing change in LIFO reserve. So let's see an application of this framework. This is the question that we have tackled when we were dealing with cost flow assumptions. It's exactly the same question. Let's please go through one more time. So our job here is to calculate LIFO and FIFO cost of goods sold and ending inventory numbers. So what do I know about these inventory numbers? At the beginning of the year, we have 100 units of inventory and the cost of each unit is $5. In January, we sell 80 units from $8 each. In February, we buy 30 units from $6 each. And in March, we buy 40 units from $7 each. Therefore, during the year, we sell 80 units, and at the end of the year, we end up with 90 units of inventory. In our previous lesson, we calculated the amount of ending inventory as well as cost of goods sold using both FIFO and LIFO. Let me please remind you. For FIFO, cost of goods sold was 80 units sold times $5, which is all coming from the beginning amount of inventory. So cost of goods sold is 400 here. And the ending inventory number is 20 units from beginning inventory, 30 units from February purchase, and 40 units from March purchase. Therefore, ending inventory under FIFO is $560. So let's just please keep these numbers in our mind. Similarly, for LIFO, cost of goods sold comes from the ending units. So 40 units comes from March purchase, 30 units comes from February purchase, and 10 units come from beginning inventory. Therefore, under LIFO, our cost of goods sold is $510. And our ending inventory all comes from the beginning inventory, and it is equal to $450. So let's just summarize this information. Ending inventory under FIFO is $560. Ending inventory under LIFO is $450. Therefore, ending LIFO reserve, which is the difference in inventories between FIFO and LIFO, is $110. Similarly, beginning inventory of FIFO is $500. Beginning inventory under LIFO is again $500. And therefore, beginning amount of LIFO reserve is 0. So at the beginning of the year, there is not much change. So by using these numbers, can we convert the cost of goods sold from LIFO to FIFO? Yes. We know that cost of goods sold under FIFO is equal to cost of goods sold under LIFO minus change in LIFO reserve. And if you go back a couple of slides back, you are going to see that cost of goods sold under LIFO is $510 minus change in LIFO reserve, which is equal to ending LIFO reserve, which we have calculated in the previous slide as $110 minus beginning LIFO reserve, that is $0. And if you do the algebra, you're going to find that cost of goods sold under FIFO is equal to $400, which we have just calculated. So how can we use this framework? First, by using this framework, we can convert inventory numbers between FIFO and LIFO. And secondly, as you can see, we can convert the cost of goods sold numbers. If you convert the cost of goods sold numbers, then in the income statement, net incomes between a firm using LIFO versus FIFO will be comparable. Otherwise, it is very hard to compare net income numbers for firms which are using different cost flow assumptions. This is especially the case if we are comparing a firm located in the United States versus another firm located in, let's say, United Kingdom. In United States, if firms can use, they use LIFO as much as they can because of the tax savings. On the other hand, LIFO is not usable under IFRS, which is applied in United Kingdom. So you cannot compare those two firms in net income numbers. It's not going to be a fair comparison. But if you apply this framework, now you can convert their net income numbers and then do a fair comparison between this British firm versus US firm. So how this framework plays in action. So here is for the inventories for year 2015. So please stop the video here and then read this disclosure, and within a couple of minutes, let's just go through this disclosure one by one. So let's read Ford's inventories disclosures in year 2015. All inventories are stated at the lower of cost and net realizable value. There is not something very particular here. Ford is saying that we are using either cost method for our or if the cost is higher than net realizable value, which is like the current market value, we use net realizable value because we are applying conservatism principle. Cost for a substantial portion of US inventories is determined on last in, first out LIFO basis. So for most of the inventories located in the United States, Ford is using LIFO because LIFO is very nice to save tax. On the other hand, LIFO was used for 27% and 28% of total inventories at December 2015 and 14 respectively. So about 28% of the inventories are valued at LIFO. Cost of other inventories is determined by costing method that approximate a first in, first out basis, which is FIFO. So most of the inventories which are located outside of the United States, it looks like Ford is using FIFO, which makes sense because LIFO cannot be applied outside of the United States. And next, we have inventories at the end of year 2015 and 14. So let's just summarize these numbers. There is a line called total inventories under FIFO. Therefore, beginning amount of inventory under FIFO is 8,885. Ending amount of inventory under FIFO is 9,259. And if you look at the last line, it says total inventories, which I'm going to call it as LIFO inventories. Beginning inventory is 7,870 and ending inventory is 8,319. Just to make sure that we are on the same page, when I say LIFO inventory, it doesn't mean that all of the inventories are valued at LIFO. By LIFO inventory, what I mean is that for inventories for which we are going to use LIFO, we have done the adjustment already. That's what it means. So one more time, ending LIFO inventory of 8,319 doesn't mean that all of these inventories are under LIFO. It means that if some of these inventories are using LIFO method, their adjustment has already been made. So what is the amount of adjustment, or what exactly I mean what I mean by adjustment, I'm talking about LIFO reserve. So the beginning amount of LIFO reserve, the adjustment to convert FIFO and LIFO inventory is 1,015. Ending amount of LIFO reserve is 940. And that is the adjustment that is required to convert inventories between FIFO and LIFO. As you can see, whenever US firms are using LIFO, they also give us enough information to convert their inventory and cost of goods sold numbers from LIFO to FIFO. Hello, now I'm going to go through some cases to see the practical implications of what we have learned in this module. This module was about short-term assets, in particular receivables and inventories. Let's get started. Here is my first case. Refer to the 2017 annual report of Samsung Electronics using the information in the statements of financial position, statements of profit and loss, excerpts of the notes provided below. Please answer the following questions. Question number 1. What is the amount of trade receivables as of December 31st, 2017 that Samsung Electronics doesn't expect to collect? That amount, by the way, all of the numbers are in million Korean won. That amount is 639,223. And where did I get this information? I get this information from Note 10, Table and A. Here it explicitly says that less provisions for impairment. And what was the name of this table? It says trade and other receivables. We have a beginning and ending amount of receivables, and here is the provisions for impairment. Here is the second question. What is the amount of trade receivables written off in year 2017? That amount is 14,367, and I got this number from Note 10, Table B. If you look at here, this is part B of the same note. If you look at the title here, it says movements in the provisions for impairment of receivables for 2017 and 16. Here we have a line called receivables written off during the year as uncollectible, 14,367. Here is the third question. Suppose that during year 2017, Samsung Electronics has collected 150 million Korean won of worth of trade receivables. And the question is telling that use the movement in gross trade receivables to estimate credit sales. Accordingly, what is your estimate of the amount of credit sales that Samsung Electronics has recognized in fiscal year 2017? To answer this question, we need to go through how trade receivable or account receivable account change over time. If you look at the third line here, ending amount of gross trade receivables or account receivable is equal to beginning amount of receivables plus credit sales minus cash collections from customers and minus write-off of these receivables. So in order to tackle this formula, we need the beginning and ending amount of trade receivables. And where will I find this? We are going to find this from Note 10, Part A. Here the receivables balances are given at the beginning and at the end of the year. So at the beginning of year 2017, we use basically end of year 2016 figure. That amount is 24,704,524, and the ending amount of trade receivables is 30,316,958. The question explicitly tells us that the amount of cash collections from customers is 150 million. Credit sales we don't know, and in the previous question we also calculate the amount of write-off of receivables, 14,367. If you do the algebra, you are going to find that the amount of credit sales in fiscal year 2017 is how much? 155,626,801. Part B of this question is asking you, what is your estimate of the amount of cash sales that Samsung Electronics has recognized in fiscal year 2017? In order to tackle this question, you need to know that total sales is equal to cash sales plus credit sales. Total sales, which you can get from the income statement, as you can see here in the red rectangle, the amount of total sales is 239,575,376. is equal to cash sales plus the credit sales that you have calculated in the previous question. And if you do the algebra, the amount of cash sales is how much? 83,948,575. Suppose that in year 2017, Samsung Electronics was considering recording a higher than currently recorded provision for impairment of trade receivables by 13,000. How would the following financial reporting items have changed had Samsung Electronics have taken the additional charge of 13,000? So if we create more impairment for receivables, all right, so we have more bad debt expense, we have more allowance for doubtful accounts, what's going to happen? Your total assets will go down by 13,000. Why? Because you're increasing the amount of allowance for doubtful accounts. It is a net contra asset account, therefore your total assets will go down. You're also increasing the amount of bad debt expense by 13,000, therefore your net income will also be lowering by 13,000. This completes case number 1. Now I am going to move to case number 2, which is about Marathon Petroleum Corporation's inventory. Please consider the excerpts from the Marathon Petroleum Company's annual report for fiscal year 2015 below and answer the following questions. To question number 1, what inventory cost flow assumptions does Marathon Petroleum Corporation use to determine the cost of inventories? It is primarily LIFO. And where did I get this information? I get this information from footnote number 2, Summary of Principle of Accounting Policies. Here there is a section for just inventories, and what does it say? Inventories are carried at the lower of cost or market value, of course, because we are conservative. Cost of inventories is determined primarily using LIFO method, and there is nothing surprising here. Marathon is a US firm, and US firms will use LIFO as much as they can to save tax. So there is nothing fancy here. Here's question number 2. What is the value of inventory write-downs in fiscal year 2015? That amount is 370 million. And where did I get this information? There is notes to consolidated financial statements. There is note 13. And here, let's just read this note all together. The LIFO method accounts for 91% and 94% of total inventory. At December 2015 and 14, cost of crude oil, refinery feedstocks, and refined products are aggregated on a consolidated basis for purpose of assessing if the LIFO cost basis of these inventories may have been written down to market values. Okay. At December 2015, the market values of these inventories were lower than their LIFO cost basis, and as a result, we record an inventory valuation charge, 370 million, to cost of revenues to value these inventories at the lower of cost or the market. Okay, it explicitly tells you that the amount of inventory write-down is 370 million. Let's move to the next question. What is the impact of this inventory write-down in 2015 on the balance sheet and income statement? Ignore any tax effects. On the balance sheet, you're going to decrease the inventory account by 370 million, right? So this inventory needs to be written. That's why it's called inventory write-down. Inventory should be reduced. On the income statement, you need an expense to balance this. So in income statement, you create either increase the cost of revenues, which is cost of goods sold, or you create an inventory valuation charge of 370 million. There is something important here. Cost of revenues, inventory market valuation name is not important. The point here is that there will be an expense recorded on the income statement associated with inventory write-downs. Most of the time when you have an inventory write-down, it is recorded under cost of goods sold. But there are also cases where there is a separate line, it just says inventory write-down. Okay? So there is an expense somewhere on income statements. In fact, if you look at the inventories, footnote number 13 of Marathon, you are going to see that there is an inventory write-down of 370 in year 2015. Look at the line. It says lower of cost or market reserve. This is exactly what inventory write-down is. You see, they are reducing the amount of their inventories. And if you want to see the charge, you need to look at their income statement. in the income statement, there is a line item under cost and expense. It says inventory market valuation charge of 370 million. So Marathon preferred to include this as a separate line item as opposed to putting this 370 on in cost of revenues. Both of them are fine. But the bottom line is there is an expense, and you can see this expense explicitly here. The fourth question here is, what is the amount of inventory purchases in fiscal year 2015? Normally, you cannot find this number directly. In order to calculate inventory purchases, you need to go through how inventory account changes. Ending inventory is equal to beginning inventory plus inventory purchases minus cost of goods sold and minus inventory write-downs. You need to use this framework to calculate inventory purchases. Beginning and ending inventory is coming from the balance sheet. All right, beginning and ending inventory is coming from the balance sheet. The ending inventory is 5,225. Beginning inventory is 5,642. We don't know the inventory purchases. That's what we are after. The amount of cost of goods sold, where will it come from? It's come from income statement as 55,583. And finally, in this formula, what we are missing is inventory write-downs that we have seen in the previous question as 370. If you do the algebra, you are going to find that inventory purchases is 55,536. The next question is question number 5. What is a LIFO liquidation? When was the last time Marathon had a material LIFO liquidation? What was the effect of LIFO liquidation on Marathon's cost of revenues and reported profits? Here is the response. There is a LIFO liquidation when a company sells more units of inventory than it buys, and as a result has to sell all inventory layers valued at lower price. The last time Marathon had the material LIFO liquidation was in fiscal year ended 2015. This liquidation increased the cost of revenues by 78 million and decreased the income from operations by 78 million. And where did I get this information? I got this from information explicitly from footnote 13. They explicitly mentioned the 78 million and its impact on its financial statements here. And here is the third case that I'm going to cover. It is about Honeywell Corporation. Please consider the excerpts from the Honeywell International's annual report for fiscal year 2010 below and answer the following questions. 1. Which cost flow assumption does Honeywell use to value most of its inventory? And the answer is Honeywell uses FIFO or the average cost and LIFO for certain US inventories. And where did I get this information? I looked at note number 1. There is a section for inventories. They explicitly say that inventories are valued at the lower of cost or market using the first in first out, which is FIFO, and last in first out for certain qualifying domestic inventories. Question number 2. Suppose Honeywell had used FIFO as a cost flow assumption for all of its inventories. We know that they use a mix of LIFO and FIFO. Would the book value of inventories at December 31st, 2010 be higher than, lower than, the same as the amount currently recorded? If different, by how much? Well, it's going to be higher by 154 million. If we are using FIFO, the amount of inventory will be higher by 154. That's generally normal. If you use LIFO, your inventories are quite small. And where did I get this information? I looked at note number 9, which is about inventories. For year 2010, I have raw materials, work in progress, and finished products, and look at the impact of reduction to LIFO cost basis. It's a negative 154. Okay, LIFO reserve is 154 million. If we were not using LIFO, inventory will be increasing by 154. The third question here is, what is the amount of cost of goods sold if inventory purchases is 35,000 in 2010? In order to answer this question, you need to go through how inventory account changes, which we have seen this framework. Ending inventory is equal to beginning inventory plus inventory purchases minus cost of goods sold minus inventory write-downs. Beginning and ending inventory is coming from inventory note, footnote. The amount of beginning inventory is 3,446. The amount of ending inventory is 3,958. Inventory purchase is given, cost of goods sold is asked. We have no indication that there is inventory write-downs. Therefore, you can assume that the amount of inventory write-downs is 0. And if you do the algebra, you are going to find that the amount of cost of goods sold is 34,488. It's a similar question. What is the LIFO liquidation? Whether this company has engaged in a LIFO liquidation at all. We know that LIFO liquidation is selling old units generally which are cheaper priced. And the last time Honeywell had a material LIFO liquidation was in fiscal year ended 2019. This liquidation decreased cost of products sold by approximately 12 million and increased the reported profit by the same amount in year 2009. And where did I get this information? If you look at note 9, if you go down a little bit, if we read this, during the year ended 2009, the quantity of inventory valued using last in first out method in our specialty materials segment declined. This reduction resulted in a liquidation of LIFO inventory quantities carried at lower costs prevailing in prior years as compared with the cost of 2009 purchases, the effect of which decreases the cost of products sold by 12 during year 2009. Suppose that the value of cost of goods sold given on Honeywell's fiscal year ending is 20,701. Okay, I know that we have calculated this number in the previous question, but let's just not worry about it. Let's suppose that I give you this cost of goods sold number, 20,701. If Honeywell used FIFO as a cost flow assumption for all of their inventories, recalculate the value of cost of goods sold on a FIFO basis. So here our job is to convert the cost of goods sold from LIFO basis to FIFO basis. By LIFO basis, it doesn't mean that all of the inventories are LIFO. Okay? LIFO basis means some of the inventories are FIFO, some of them are LIFO. It's a mix. Our job is to convert everything to FIFO. And what was the formula for this? Cost of goods sold under FIFO is equal to cost of goods sold under LIFO minus change in LIFO reserve. Cost of goods sold under LIFO is given in the question. And then we need information about beginning and ending amount of LIFO reserve, which we get from note 9. Beginning amount of LIFO reserve is 161. Ending amount of LIFO reserve is 154. And if you do the algebra, cost of goods sold under FIFO is how much? 20,708 million for this company. Here is case number 4. Refer to 2018 annual report of Microsoft Corporation using the information in the income statement, balance sheet, and excerpts for of the notes provided below. Please answer the following questions. Question number 1 is asking you what is the amount of account receivable as of June 2018 that Microsoft doesn't expect to collect. In other words, the question is asking you about allowance for doubtful accounts, and this amount is how much? 397 million. So where do we find this information? You can look at note 1, accounting policies. We have contract balances, and these two tables are given to you in the question. The first table is activity in the allowance for doubtful accounts as follows. So if you look at the last line here, it says 397 in year 2018, or you can look at the second table, just like what I have done in the solution here. It says allowance for doubtful accounts included in our consolidated balance sheet is, at the end of year 2018, 397. Out of 397, 377 is in account receivable, net of allowance for doubtful accounts on the balance sheet, and 20 is included under other long-term assets. The second question is asking you what is the amount of account receivables written off in fiscal year 2018. The answer is 98 million, which we can find again from note number 1. If you look at note number 1, the first table, and the first table is telling you about how allowance for doubtful accounts change. There is a line called write-offs. If you look at the amount of write-offs, it is 98 million. Suppose that during the year end of 2018, Microsoft has collected 86,000 worth of account receivable. Again, we are going to use the gross account receivables to estimate credit sales. So here is the part A of this question. What is your estimate of amount of credit sales that Microsoft has recognized in fiscal year 2018? To answer this question, just like before, we use our usual framework. How gross receivables change. Ending gross receivables equal to beginning gross receivables plus credit sales minus cash collections from customers and minus write-offs. The challenge of this question is to come up with these gross account receivables numbers. So let's just go through this just for the ending amount of receivables. Ending amount of receivables, you need to have net amount of account receivables, and you need to add the amount of allowance in year 2018. We know from the previous question the allowance for doubtful accounts for year 2018 is 397, so there is no problem. But what is the ending amount of net account receivables? Well, if you look at the balance sheet, you are going to see that in year 2018, the amount of ending receivables is 26,481. Is this it? That's all? If you continue, again, if you look at note number 1, there is this paragraph. It says, as of June 2018 and 17, long-term account receivable. Okay? The account receivable you see on the balance sheet is short-term. Okay? Long-term account receivable, net of allowance for doubtful accounts is 1.8 billion and 1.7 billion. All right. Therefore, in order to calculate the amount of gross account receivables, what are you going to do? You are going to add current net account receivable. You are going to add a long-term net account receivable, and you are going to add the amount of allowance of 397. Therefore, the amount of ending gross receivables is how much? 28,678, and you calculate the amount of beginning receivables similarly. And if we go back to framework, we know the beginning and amount of gross receivables. We don't know the credit sales. That's what the question is asking you. Question also tells you that the amount of cash collections from customers is 86,000. And in a previous question, we have seen that the write-offs of receivables is 98. And if you do the algebra, the amount of credit sales is how much? 90,284. Part B of this question is, what is your estimate of amount of cash sales that Microsoft has recognized in fiscal year 2018? In order to tackle this question, you need to know that total sales is equal to cash plus credit sales. Total sales is 110,360. Where is this coming from? It's coming from income statement of Microsoft. In the previous question, we estimated the amount of credit sales. It is 90,284. Therefore, the amount of cash sales, actually our estimate of amount of cash sales is how much? 20,076. Suppose that in fiscal year 2018, Microsoft was considering recording a lower than currently recording provision for impairment for trade receivables by 35 million. Okay, we are going to reduce the amount of provision for allowance for doubtful accounts by 35 million. What will the impact of this policy on total assets and net income? Of course, total assets will go up by 35 million because you are reducing the amount of allowance. Allowance is a contra asset account. Your net income will also go up by 35 million because you are reducing the amount of your bad debt expense. And here is my case number 5. It is about BlackBerry. It's a Canadian firm. Please consider the excerpts from BlackBerry's annual report for year 2014 below and answer the following questions. Question number 1 is asking you what inventory cost flow assumption BlackBerry uses. That's FIFO. Not surprising because this is a Canadian firm and LIFO is used in the United States. And in fact, if you look at note number 1 under inventories, there is this sentence. It says cost is determined on a first in first out basis. 2, what is the value of inventory write-downs in fiscal year 2014? That amount is $1.6 billion. That's a huge number. All right, where is this coming from? You are going to look at note number 5, consolidated balance sheet details. Under inventories, we have this paragraph in red rectangle. It says, during fiscal year 2014, the company recorded charges against inventory and supply commitments of approximately $2.4 billion. These charges include an inventory write-down of $1.6 billion and supply commitments of $782 million. What is the impact of this inventory write-down on the balance sheet and statement of operations? Ignore any income tax effects. On the balance sheet, we are going to reduce the inventory by 1.6 billion. Inventory is write-down, therefore you reduce the amount of inventory. On the statement of operations or income statement, you are going to increase the cost of sales by 1.6 billion, just like we have discussed before. it's not obvious where you are going to exactly put this 1.6 billion. Some firms put in cost of sales. Some firms write this explicitly as an extra line item. The name doesn't matter. The location doesn't matter. What matters here is that there will be an income statement expense of 1.6 billion. 4. What is the amount of inventory purchases in fiscal year 2014? Well, in order to answer this question, again, we need to use our framework. Ending inventory is equal to beginning inventory plus inventory purchases minus cost of goods sold minus inventory write-downs. Where does the beginning and ending inventory come from? They come from the balance sheet. The amount of ending inventory is 244. The amount of beginning inventory is 603. Inventory, we don't know the inventory purchases. We need some information about cost of goods sold. Where will I find information about cost of goods sold? It's going to come from income statement. So the amount of cost of goods sold is 6,856. And the amount of inventory write-downs that we have just discussed, 1,600. If you do the algebra, the inventory purchases in this year is how much? $8,097 million. And now it's time to cover our last case. It's about GE's annual reports. And the first question is a similar, familiar one. What cost of assumption does GE use to value most of its inventory? A portion of GE's US inventory is valued on a LIFO basis. Other inventories are valued on a FIFO basis. Where is this information coming from? Note number 1. They explicitly say that, and it's not surprising. This is quite normal. US firms can use LIFO as much as they can. When they are operating in outside of the United States, they need to use something else, and most of them they use FIFO. Suppose GE had used FIFO as a cost flow assumption for all of their inventories. Will the book value of inventories at December 2016 be higher than, lower than, or the same as the amount currently recorded? If different, by how much? Well, this is an interesting one. If we use FIFO, actually inventories will be lower by 383 million. So where will I find this information? I'm going to look at note number 5. Note number 5 has inventories. And here there is a section called revaluation to LIFO. And if you look at this one, it's actually a positive number. All right? Most of the time, and this is, by the way, the first time I see LIFO reserve actually increases the amount of inventory rather than decrease. All right? For some reason, their older units are much more expensive than their newer units. Therefore, their LIFO reserve is actually a positive number of 383 million. So if they were using FIFO, their inventory will be lower by 383 million. Here is the next question. What is the amount of cost of goods sold? The inventory purchases is 72,000 in 2016. So we need to use our usual framework. How does inventory account change? We need beginning and ending inventory, which we can get from note number 5. Ending inventory is 22,354. Beginning inventory is 22,515. Inventory purchases is given as 72,000. And there is no indication that there is an inventory write-down for this firm. Therefore, cost of goods sold is 72,161. If GE had used FIFO as a cost flow assumption for all of their inventories, recalculate the value of cost of goods sold on a FIFO basis. Again, we are going to use our usual formula between FIFO and LIFO cost of goods sold conversion. Cost of goods sold under FIFO is equal to cost of goods sold under LIFO minus change in LIFO reserve. But there is a catch here. Remember, their LIFO reserve is not a usual one. Okay, its LIFO reserve is actually increasing the value of inventory. Therefore, when I am calculating this change in LIFO reserve, what do I do? For 383, which is the 2016 LIFO reserve, I multiply them by 1, minus 1. Okay, so they are actually inventory value increasing LIFO reserves. They're like contra reserves, if you want to call it this way. Therefore, all of these reserves are multiplied by minus 1. So when you are calculating life reserve. The first number is 383. I put it into minus. And there is another minus coming from the formula. And then there is another minus on 207. All right, this is again an inventory value increasing life reserve. And if you do the algebra this way, you're going to find the cost of goods sold under FIFO is 72,337. This is a quite unusual case such that we have FIFO life reserves which are actually increasing the amount of inventories. That's the reason why when we are calculating change in life reserve, these life reserve numbers are first multiplied by -1, and then we have done the algebra. So this is the end of our cases for module number 4. See you next time.
At Geese College of Business, one of our strategic priorities is to democratize education. We do that by delivering our IMBA, IMSA, Executive Education, and Business Minor online. That is not business as usual, and it is certainly not the online education of old. We put our very best faculty in the online space. They actively engage with students from around the world, face-to-face in a digital classroom. Faculty and students collaborating together infuse these programs with the personal attention that enables students to reach their full potential.
The IMBA program through the Geese College of Business is so incredibly innovative. The ability and accessibility to reach a whole new audience of students and let them learn on their own time has been phenomenal. And being able to collaborate with people across the globe and to learn from top-notch professors has been completely revolutionary.
When you're interacting and teaching in a live session, you can kind of see the student's environment. And while I'm teaching here at night in Champaign, it's daytime wherever they are in the world, some of them. And so it sort of slaps you in the face immediately that there's a completely different perspective.
You might think, oh, it's more removed, it's more distant. But in fact, my experience in an online class has actually been surprisingly intimate and connected. In a classroom setting, you might have 50, 60 or more students in a room at one time, and so I'm scanning around looking at people. But in an online, I'm looking at one place and the student's looking right back at me. And that's surprisingly a direct experience.
I was shocked at how much it felt as good or better than when I was sitting in class in my undergraduate days. Everyone has their cameras on their computers. There's a chat feature so you can also type in a question and the professor can answer your question that way.
I think the cool thing is that you can truly participate from wherever you are. These systems work on your desktop, on your cell phone.
We were traveling in the middle of nowhere back from Indiana, and on the Wi-Fi still on my iPad, I was able to connect through Zoom with classmates in Dubai and Tokyo and California all at the same time. Even being in a remote place, on the go, the accessibility and the exposure that I was able to get was phenomenal.
Getting my MBA makes me feel empowered because I don't need to stop being myself. I don't need to stop working. I don't need to stop being a mother. I don't need to stop having my life. And that is everything.
Our online programs are designed to be career-curated learning experiences. Our leading-edge course material is structured the way that professionals apply these concepts every day. Leadership, communication, and critical thinking skills are built into the core, empowering our students to put their purpose into practice at the highest level.
One of the most impactful things is just your ability to take the skills that we deliver and take them back to work on Monday. I've heard a couple of stories where students have talked about the skills that they were able to build over a couple of weeks, and then they were able to immediately bring that skill set back into their job and make an immediate impact.
I would recommend Geese IMBA program for anyone. This is both if you're starting questioning your career, to if you're a professional and you want to hone your skill, this is it. This is the place to be.
At Geese College of Business, we are truly revolutionizing how online education is delivered. This isn't just a few PowerPoint slides and a reading assignment. Our faculty and students thrive in this one-of-a-kind global classroom. Relevant, timely discussions about current topics from around the world keep content fresh and exciting. The next generation of business leaders will come from all corners of the world, and now they converge here at Geese Business.